and probably going higher.
Michael, it has been a tough year. It has been one of the toughest years I can imagine, exhausting, a lot of people will say, unless they were all in on NVIDIA. And I'm wondering, if you've missed it, what do you look for to know whether this is going to be a FOMO or a MABU or whatever you want to call it, and it's going to keep going for a while, or if it's basically luring people in to just be, annihilated in a couple of weeks?
I think anybody's going to get annihilated in a couple of weeks. I mean, I think it takes time for a confident, if to call it a confident market like this to fall apart. It would take something different. As I say, I don't see any real deterioration in the economy, and I don't think there's a lot of downside and cyclicality, which is, I mean, that's still a fairly cheap part of the market.
So you're going into equities right now?
We have been in cyclical equities this year. It hasn't really worked so far. But I do think that a sort of more optimistic overall mindset will lead people to understand that the economy is okay, and the cyclical portion of the equity market, I think, can play catch up.
I look, Michael, back at the analog of the 70s, and granted it was a horrific recession versus a horrific pandemic. We came off the bottom in 1974, up 52%. World's going to end, that's it, there's the bounce, short squeeze, whatever. And then we went up another 29% into 1976, 77 as well. How do we generate a second leg to a bull market that started in October?
I don't think it's... The bear market last year wasn't like 74. We used that 74 analog a lot back in 2008. When people really thought the world had ended. But as I say, I think that there's room for the average equity market, the S&P equal weight, only crossed back into positive territory for the year this year. There's room for a lot of whatever I call them average equities to do okay in this kind of an environment. I'm still of the belief that at some point interest rates are going to be the story, and it's more likely to be the longer end of the curve rather than the short end of the curve. I think this time that causes some disruption. But I think between now and then, I would be hopeful that certainly portions of the global markets, Asian markets, have really quietly had a very good year this year. It's not just Japan; it's markets like Korea as well, and the sort of cyclical portion of the U.S. equity market, I think can generate okay returns.
Does Asia develop a disinflationary pulse that assists the U.S. markets?
No, I think it's just the sort of quality of corporate earnings over there is better than people expect, and I'd say a market like Korea is still a pretty cheap market out there.
We've had conversations with you over the last several months about the prospect of a lost decade of returns at the headline market cap weighted S&P 500. A few months in to the year, and already we were talking about US exceptionalism driven by 5 big names on the S&P 500. It doesn't feel like the conversations change. Is that just a 6-month moment in time that we leave behind, or are you questioning maybe some of the ideas that we were discussing in the last few months with you?
No. I mean, I still think that the headline index, that sort of great year it had in 2021, I think you're going to pay for it. I think you're going to pay for it for several years. The S&P is still 15% below its peak in 2021. So you have a good way to go. But I am surprised and impressed by this new wave of enthusiasm. It took something new for people to get excited about, but they've been given it with AI. And this thing will have to run its course.
Let's just build on that a little bit more. In the last decade, we had FANG.
Yeah.
Europe didn't. And now all of a sudden in 2023, we have NVIDIA and others, and Europe does not. And I think that's part of the question too, whether we can really get this global cyclical story going at the equity market level, with that being the dominant equity market story of the moment. Is that competing with the way you were thinking about things coming into 23?
As I say, yes and no. As I say, there's portions of the global market which have behaved as I would have expected. As I say, some of these like boring cyclical indexes have really had a good time of it on the other side of the world. Within the US, those sorts of equities simply haven't performed in the way we would have wanted them to do so. And I think in the US, there is a process of capital being sucked into the big technology names away from the part of the market we like.
In dollars, Korea up 36% off the bottom, SPX up 20%.
Get a chart of the Nikkei. Get a chart of the Nikkei up. Yeah, Japan as well. Yeah. Michael, this was great.
Thank you.
Thank you. Fantastic to catch up with you. Michael Schall of Market Field, supporting Inter Milan, I think.
I will be.
This weekend, no doubt.
Forlornly.
Binky Chowdhury at Deutsche Bank coming up in the next hour. Looking forward to the conversation. Binky thinks we can get out a few more 100 points on the S&P.
Has Binky nailed it or what?
It's doing better this year.
Wow.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New Yorkers can breathe a little easier today. City environmental officials say the air quality improved overnight to moderate. Still, people sensitive to pollution are being advised to take precautions. New York's air quality index improved 100 on a scale of 0 to 500 early today. That reading reached the most serious level of hazardous earlier in the week as smoke from the wildfires in Canada moved across the U.S. Northeast. Tesla shares are poised to rise for a record 11th consecutive session, matching the stock's longest winning streak set in January 2021. That after General Motors said it would adapt its electric vehicles to Tesla superchargers. It follows a similar move from Ford. Tesla shares have risen more than 90% so far this year. UBS has sealed an agreement with the Swiss government to cover $9.9 billion of losses it could incur from the rescue of Credit Suisse. Now, that clears a major hurdle to closing the historic takeover. The agreement covers about 3% of the combined assets of the merged bank. And Bank of Japan officials see little need to adjust its yield curve control program. Bloomberg has learned that a move is unlikely at next week's policy meeting, given the improvement in the functioning of the bond market and the smooth shape of the yield curve. Now, according to a Bloomberg survey, nearly all economists expect no major policy shift at the meeting. I'm Lisa Mateo, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I'm an innocent man. I did nothing wrong. And we will fight this out just like we've been fighting for 7 years. It would be wonderful if we could devote our full time to making America great again. And that's exactly what we did. But now, again, our country is in decline. We're a failing nation. And this is what they do.
The former president of the United States, President Trump, there on Truth Social. In the last 24 hours, the former president indicted over his refusal to return classified documents found at his Florida home. This according to 3 people familiar with the matter. The next steps over the next week, the former president, Donald Trump, told to appear in federal court in Miami on Tuesday, Tom. So this one is going to pick up through the weekend and into next week.
I thought the brief from Terry Haynes earlier was great, which is this is not a time to be a lawyer or to play junior lawyer. And what Lawfare blog, Scott Anderson and Ben Whitty say what is really important. We're blind until Tuesday. So it'll be an important conversation. But everyone, including the president, is blind on this.
We're working on our reporting from our colleagues here, Tom.
Yeah.
The US charges include document retention and conspiracy to obstruct. That's the latest reporting at the moment.
Yeah. Emery Horton with us right now, our chief indictment correspondent in Washington. It seems to not go away. We were talking state court in New York. There's issues in Atlanta, maybe coming, who knows. Was this a surprise for Washington to see this? It's got to be that you knew it was coming, right?
It wasn't a surprise because we did see recently Trump's lawyers show up in Washington, D.C. They were at this meeting at the Department of Justice. What was more surprising is this wrinkle that there's also been a grand jury taking place at the same time in Miami. And this was something that
Explain that. What does that mean?
Know that.
No, that is very new. We learned about that last week, reporting from the New York Times. So when the document case started, it obviously started in Washington, D.C., because these documents were taken from the White House. Then, of course, they were found in Mar-a-Lago. We all remember the search of the former president's resort in Palm Beach last year from the FBI. They were going after these classified documents. There was a subpoena to collect them. He didn't oblige. So they went after these classified documents. So now when the special counsel was looking into this, everyone thought the grand jury was just taking place in Washington. But now it's happening in Florida. And Florida is a place where the former president has a lot of support. It is a state he won. It is his own turf. So everyone thought that if there was going to be this indictment in Washington, he would certainly try to move it to Florida. But now it's already happening in Florida. So that's the wrinkle that I think most people were surprised about. Not that he wasn't going to get indicted.
This year, we've seen it a million times. How many former officials, current officials have documents, have found documents, didn't know they had documents. Do we know so far about what's different about this case with the former president compared to, say, others?
So two things. One, we already see that Mike Pence, who's now also running for president, he has been cleared. Biden, there's still a special counsel looking into his case that is still pending. Two things that are very clear about Biden and Pence: they invited authorities into their home to come in, canvass areas, even their second home, their offices, to collect the documents themselves. The former president was asked by the National Archives to give back the documents, and he did it. And you have Bill Barr 2 days ago on CBS This Morning saying, this is a case of his own making. This is the former president's own attorney general saying he was just jerking around the Justice Department. If he had just returned the documents, he says that the DOJ has provided a lot of deference to the former president, but if he had just returned the documents, this case really would have went away.
We're not lawyers. We can't necessarily weigh in on charges, especially because we have not seen them laid out in the indictment, but we can get responses from political opponents, including from the Republican Party. And that really may be one of the key questions over the weekend. What is the response of the other candidates? Do they back him, or do they step away and say this is a reason why he shouldn't be president?
Yeah, I think this is going to be a real litmus test, right? Every single Republican candidate is now going to be asked, will you pardon the former president if he is supposed to be going to jail? Some of these charges, and again, we don't know everything, but we potentially could get the indictment today. That's under seal. Some of them come with 20 years prison sentences. Some of them come with 10 years prison sentences. They're all going to be asked, would you pardon the former president? And that's going to be a difficult one for individuals to answer. Mike Pence couldn't answer that at the CNN town hall. He said he wouldn't want to deal in hypotheticals.
Is there still a fear of deep state in the broader population that will percolate out in poll numbers?
I'm not sure it's in the broader population, but it certainly is in the 30% of the base of the Republican Party that Trump has a handle of. Listen, every time the former president is faced with a massive hurdle, with a lawsuit, his numbers go up and his advertising campaign donations also go up. The bigger question as well is, as this continues, and Tom, you mentioned potentially what happens in Georgia, potentially there's another suit Letitia James is looking at into his company here in New York. Do all of these just start to become so overwhelming and you become Trump legal fatigue, and potentially he starts to lose some of those would-be voters?
I'd point to Lisa's comments on pardoning that, folks, there's a huge issue in the zeitgeist right now about Gerald Ford and Richard Nixon from a few years back as well. Is it safe to say that the contributions the President Trump is getting are paying for his legal bills?
I'm not sure.
We don't know.
I'm not sure that would be fair to say right now. Potentially some of them, though.
I'm thinking he's got, what, 3 geographies? Is that right?
In
to
terms
deal
of,
with? New York, Atlanta, Miami?
No, 4.
4.
New York, Atlanta, Miami, and also Washington is still looking into the insurrection.
I find it extraordinary, this process. What will you look for in the next, what will you look for Tuesday? Let's focus on Tuesday. We're not going to get what we saw before, which is cable TV news monitoring John for what?
Are we not?
8 hours?
Why wouldn't we? I mean, the president, it's a very quick
know.
drive from West Palm Beach to Miami. He's, at the moment, I believe the former president, though, is in New Jersey. He'll be obviously likely be flying back to Mar-a-Lago before he goes to Miami. But I imagine cable news will be following his road down from West Palm Beach to Miami. It's a beautiful drive.
Do you know a good lawyer?
Do I know a good lawyer?
I've been cleaning out some stuff.
Have you found some documents?
I shredded, Good Morning Heidi Prisbel at Politico, a photo of me and Heidi with President and Mrs. Bush from a few years ago.
Is that going to get you in trouble? Was that classified?
I think it could be a felony offense.
What was the photo of?
We shredded the Christmas party.
Was it Tom with a Republican?
You make no. It's the Christmas party. Anne Marie goes to it every year. I mean, it's the White House Christmas party, and you do a photo with the president.
I want to build on something Lisa said to wrap things up. Lisa asked about the candidates being asked to whether they'd pardon the former president. Yeah. Just to go one step into that conversation a little bit more, I just wonder, for the likes of Governor Christie, isn't this part of the pitch? Isn't this part of the pitch for some of those candidates? Don't they come out and say, this is it, the former president is clumsy, this is the way he behaves, it's reckless, and et cetera, et cetera? Does it go in that direction?
Well, the issue is that the former president is innocent. You're innocent in this country until proven guilty, and that is the tone the former governor of New Jersey took. So Chris Christie said, let's see the facts are when there's a possible indictment, when that's released. As I've said before, no one is above the law, no matter how much they wish they were. We will have more to say when the facts are revealed. So a lot of individuals will also want to punt. They want to give themselves some time. They want to make sure that now that they are running against the former president, they can't be seen as trying to weaponize this, and they're going to play it, I think, some of them very straight.
Interesting. It will be very interesting to see how that develops over the weekend. That's for sure.
Garrett, Red Sox, Yankees, where are you sitting?
We're doing baseball.
Where are you sitting?
Is that going on?
I'm sitting behind home plate, of course.
Are you going to the game this weekend?
Otherwise.
Are you? AMH, it's good to see you.
I bought a ticket for Tom.
Are you going to the game this weekend?
The Red Sox, folks, this is important. The Red Sox are so weak in this division, they're bordering on the 1965 Red Sox, which ruined my childhood. I was scarred. They lost 100 games. Frank Malzone is the only reason. Dick
How many games did they play?
Like 160 games, and they lost 100
and they lost 100.
Yeah, worst team ever.
Wow.
There it was.
Say that again. Boston Red Sox, worst team ever.
Worst team ever. Can we put that in a banner? Can we get that in a banner?
Garrett Cole is really fun to watch. He's really impressive, I have to admit.
Is Judge back?
I don't know.
No, I don't think so.
I don't think so.
No, he's hurt.
Okay. Is that the end of the baseball talk?
It's baseball talk. Let's get back to Manchester City.
Kathy Jones is coming up. Charles Schwab on a mid-year outlook. We're going to catch up with Kathy in about 5 minutes' time. Look out for that conversation on the data front. Really light on the economic data front at the moment going into next week, but it picks up next week. On Tuesday, CPI data, on to Wednesday, and the Federal Reserve. Equity futures just about unchanged on the S&P 500. Yields just a touch higher by 3 basis points, 374.91. And the euro just short of 108 at the moment, 107.70, and negative about 0.1%. Getting you to the weekend live on Bloomberg TV and radio.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors that play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Equities on the S&P 500 shaping up as follows. On the S&P, we look a little something like this. Basically unchanged, going absolutely nowhere. On the Nasdaq, we're positive by 0.08%, more than positive by 0.08% on the year, flying. On the S&P 500, off the lows of October, up by more than 20%. You're going to wake up to a lot of headlines about bull markets and narrow leadership, and 5, 6, 7 names on the S&P doing all the heavy lifting. More recently, though, month to date so far in June, some of the small caps, the Russell, starting to pick up the slack just a touch. The Russell this morning down by 0.1% on the month, for the month of June, up by around about 7% or so for the small caps. Let's see if that continues, and to Lisa's point, whether this equity market rally so far this year begins to broaden out.
That's a distinction this week. The small cap move is a distinction this week. Michael Schill brought this up, and it's, for me, it's a new conversation. It's not a bank conversation per se. It's there, granted, the banks, but it's a new part of it.
Will it continue? This is something the likes of Bank of America and Savita Subramanian are looking for more of. Savita pointing out that Apple is bigger than the Russell 2000, which is something worth thinking about. In the bond market, the 2-year, 10-year, 30-year looks a little something like this. The 2-year, I have to say the bond market stuck between a rock and a hard place this week, just whipsawed by surprise rate hikes on one side, pushing yields higher, and then soft economic data yesterday, jobless claims pushing yields lower. Then it's on to CPI on Tuesday, the Federal Reserve on Wednesday. Good luck out there. 455 on a 2-year, 374 on a 10-year, yields higher by about 2 or 3 basis points. I do want to finish on a single currency, the euro, and just talk about the revised economic data that we had out of Europe in the last 24 hours, suggesting that we've had 2 consecutive quarters of negative growth. Most people call that a recession, but I haven't got time to have that debate with you this morning. We have had no growth in Europe in Q4, no growth in Europe in Q1, and yet still we have an inflation problem. And I think there's a much broader conversation to have about the economics of that. Guy Johnson bringing up this point out of London yesterday. That's a problem for the ECB, Lisa, and maybe even a problem for the Federal Reserve. We're talking about the softer growth they were looking for, hoping for. That was an objective, almost a target, to get inflation down, and they've had it, and not much happened.
And so how are they going to justify not hiking rates at a meeting where it's clear that any kind of weakness isn't really exactly all that painful? What I'm watching, we've been talking about it throughout the morning, Tesla coming out with a huge win. General Motors saying that it will use its electric vehicle superchargers, and really got on the bandwagon that Ford had already gotten on. Basically, is Tesla still a car manufacturer, or is it the infrastructure for a broader EV network in the United States that is adapted by some of the other auto manufacturers? Those shares up 6%. I believe it is the longest streak, I believe 11 straight days of gains on Tesla, the longest going back to 2021, one of the record lifts. We've seen General Motors shares up 4.7% as well. Carvana, fascinating to me. Today's move, nothing to write home about. But yesterday, a record 56% surge. The short positions absolutely decimated. All these people trying to leave this company for dead. And it came out and said, we're improving. And everybody who was trying to short this company got blown up.
50 to 350. I think that's a moonshot. Cratered.
What are we looking at?
Carvana,
okay,
left for dead. CVNA, left for
Just
dead.
making sure, you never know.
9 to 24. See the abuse I get here, Kathy? It's just terrible. 9 to 24.
That was nice.
They made it back to 24.
Okay, I understand. You can talk about levels, you can talk about percents. The point is, people are looking for the companies during the pandemic that were left for dead, and they've been trying to pile on, and then, oh yeah, they're not dead yet. It hasn't been the zombie roll-up. And another one, DocuSign, really bid up during the pandemic, and what you have right now is you have shares up more than 5% after coming out, raising their outlook, seeing better than expected earnings. Again, some of these companies that grew up during the pandemic are adapting and adjusting, Tom, and here they are, and they're actually delivering some of the results.
She's on it today.
She's on it today.
Who wrote the script for her?
She is. That was good.
She's just killing it.
What do companies do, Tom?
Is it too early for a beverage?
They adapt and they adjust. Charles Schwab out with their mid-year outlook. Kathy Jones and the team weighing in on the Fed writing this. We look for the Fed to keep its policy stance largely on hold in the second half of the year, although one more rate hike is possible. A shift to easing policy would only likely be seen if the economy were to fall into recession or if financial stability issues were to re-emerge. TK, that's their view.
That's the view of Charles Schwab. Kathy Jones joins us right now. They're fixed income strategists. And I'm going to go to someone we were talking about with your exquisite ability to play piano, which is Gershwin George, where he said, life is a lot like jazz. Boy, you better improvise. How do you improvise in the bond market with the oddity of post-pandemic economics and the oddity of the ambiguity, I should say, almost about where we are right now?
Yeah, I mean, I think that's really the challenge not only strategists have, but also the Fed is facing, right? How do they set policy in an environment that's really very unfamiliar? The way we've been doing it is simply either barbelling or laddering, and not trying to play every little up and down in the market. So if, you can stay short and try to roll out and time it perfectly, but there's a lot of reinvestment risk if you miss it because these moves are so fast.
Are you doing this with combining your work with Liz Ann Saunders? Are you doing it with the understanding there will be a jump condition in the short end or even a dramatic movement in the long end, or do you see sort of stability out there as you barbell or ladder?
Yeah, we think in the bond market it'll be more stable. We had huge volatility in the first half of the year, and I think that was the market readjusting to Fed policy and all the surprises that we've had. And yet, we haven't gone anywhere, right? We had all this volatility, and yields pretty much from 2 years out are about the same as they were at the beginning of the year. But we think second half should be somewhat more stable, I mean, barring some sort of crazy financial market event that seems to happen every 6 weeks. But barring that, I think that we should have a fairly stable move here.
There's this sort of renegade theory out there right now, trying to justify perhaps some of the moves and some of the resilience in the economy, or else it's just true, which is we've been talking about the lure of 5.5% on cash as a negative, as sucking liquidity out of the market. But some people say it's actually stimulative because all of a sudden you can get returns on your cash, which gives you more money to go out and spend that much more. Which is it?
I guess that's a tough question to answer. I think the 5%, the higher yields are more punishment than reward, right? Because the number of savers that are actually benefiting from that are doing fine, but you have a whole bunch of people who are companies and individuals trying to borrow, either get a mortgage, a car loan, companies trying to refinance at higher rates. I would say it's more negative than positive.
It's negative in theory, but this is what I keep hearing from people, that nobody who's buying a home is paying 7% mortgage rate. Everybody's getting some other mortgage rate. Companies can get pretty low rates if they're a good company. On average, they're high, but those companies that have to pay through the nose aren't borrowing at those rates. So this interest rate effect, the punishment, isn't actually bleeding into the economy, and the reward is actually driving even more investment. Is that an accurate way to understand the dynamic that's been so confounding so far this year?
Well, I would say the credit conditions have been easier if you go to the capital markets than it would normally be under these circumstances. But if you're like I say, you're a low credit borrower, those costs really are going up, and we're seeing a lot of weakness at the low end of the credit spectrum. And I think it's just a matter of time. It's hard to believe that we can have all this tightening, 500 basis points in a very short period of time, QT also at the same time, and not have an economic effect.
1 year forward, laddered or barbelled, whatever the blend is, full faith and credit, corporate, are you clipping a coupon or can you actually manage and position for total return?
I think that the bulk of what you'll get will come from the coupon, but you can position to get some total return.
You're going to give me a double-digit total return?
Not double digit. I think that would be very unlikely.
If I don't get 11%, I can't come to Schwab.
No, I'm sorry. No, I think 11%.
Well, that was just, folks, I'm busting chops with Kathy Jones. That was a discussion from about 10, 12, 20 years ago. That was fun, wasn't it?
It was. It was.
Can I give you a stat to build off what Lisa said?
Please.
1/3 of homes in this country bought with cash.
I noticed. I'm glad you bring that up.
Highest share in like a decade. That was also the stat, by the way, for the whole of last year, too, from Redfin. So 1/3, Lisa, to your point.
Yeah, they're bought in cash. And then the others are bought from developers straight up that are offering them much lower rates, or they're refinancing existing, or they're sort of taking on other loans for lower. Again, the point being, the impulse isn't making its way into slowing the economy in a material way. And this is the reason why people are wondering, why hasn't it been more painful?
Oh, they're buying new homes because older ones aren't for sale.
Exactly.
Because they've got people in them with mortgages at 3%. This housing market is totally distorted.
Completely.
It's totally distorted.
I would suggest it's always been distorted, and the pandemic made it shockingly. I mean, the rent now is $4,300 something. Jonathan Miller Samuel.
It's nuts. But ask yourself
nuts.
this, Tom. This is a big question to ask, and it's connected to monetary policy and built on what Lisa's talking about because it's so important. Are the long and variable lags longer, like 30 years long, because mortgages at 3% are like 30 years long, and everyone did that? I hope you did that. I didn't do that. I wish I had done that, using the term everyone loosely. Or are we just finding out this economy is way more resilient, Kathy, and that 5% doesn't get it done?
Yeah, I think it's the long and variable lags are longer. And, let's put housing aside and let's look at all the other costs that are going up. And also the fact that we've had sub 2% growth now for several quarters. Manufacturing sector is really very weak. And we're starting to see the ISM numbers on the service side come down as well, new orders. So I think it's been longer because we had such a fiscal and monetary policy response to the pandemic that it's taking longer for it to work its way out. But it's hard for me to believe, again, that that's not going to happen over time. And I think that's the Fed's whole hold on to high rates, because if inflation continues to come down, holding is tightening. And particularly with QT going on in the background.
This is such a good point that's missed by so many people, and I totally agree with you. You can keep the nominal rate steady, but the real rate shifts. Right. That's the point, right?
Right. And real rates are up. And if they stay up for another year or so, that's going to have an impact on the economy.
Okay, 10-year real rate 1.54%. I modeled out 2.05% as sort of before all this idiocy. Do you people suggest we'll see a 10-year real rate that'll migrate back to the sort of the moving averages of another time and place?
I think 2% might be a little bit on the high side for a 10-year, but we'd be actually looking at tips right here and locking in some of those real yields.
Interesting. Kathy, it's good to see you. Kathy Jones at Charles Schwab. Wonderful conversation. So hard to relate to the idea that a third of the houses sold here are bought with cash. That, the distinction between the haves and have-nots. If you're not one of those, you're thinking, are you serious? Really? A third of housing in this country is bought with all cash?
Guess who's buying that? Guess which third of the population?
Yeah.
But you've heard this from me before. It's not news, but I'm in the camp where we've wildly disaggregated as a society. And yes, it's the haves, the have-nots. It's the two Americas. Maybe it's three Americas. But there's an America out there loading into property and foreigners as well with cash.
Nadia Calvino coming up. Conversation you don't want to miss with the Spanish finance minister. Need to talk about the drought in Spain. Bramo's concerned about the olive oil supply.
It's bad.
There's a lot to talk about here. Your equity market just about unchanged. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New Yorkers can breathe a little easier today. City environmental officials say the air quality improved overnight to moderate. Still, people sensitive to pollution are being advised to take precautions. New York's air quality index improved to 100 on a scale of 0 to 500 early today. The reading reached the most serious level of hazardous earlier in the week as smoke from the wildfires in Canada moved across the U.S. Northeast. The UK has posted fresh health warnings through the weekend. Soaring temperatures caused by a blast of hot air have pushed the nation's health security agency to issue an alert for parts of the country from Friday, signaling risk for people over 65 and those with pre-existing conditions. Now, temperatures will reach nearly 82 degrees in the British and German capitals on Saturday. Binance is being cut off from its banking partners after a lawsuit from the Securities and Exchange Commission. The cryptocurrency exchange says it could happen as early as next week and told its customers that it's suspending USD deposits and recurring buy orders from transitioning to a crypto-only exchange. Binance calls the SEC's allegations unjustified. Former Barclays CEO Jess Staley has been out of sight for more than a year and a half as the revelations about his relationship with disgraced financier Jeffrey Epstein piled up. But in New York this weekend, Staley is scheduled to give his version of events for the first time. A pair of lawsuits allege he witnessed an assault on a young woman and may even have participated in a sex trafficking ring run by Epstein. Staley's lawyers deny the allegations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Had a slowdown in activity, and yet inflation still remains kind of uncomfortably high. It's definitely a lot easier than it was a few months ago because, again, you've got those base effects, you've got energy prices coming down. But I think in many ways the ECB's job is one of the easier ones. It's the Federal Reserve, I think, that has the tougher challenge up ahead.
Fantastic to hear from Marceline Yosser, the Global Head of FX Strategy at RBC. Just commenting on the weakness we've seen in European growth in Q4, in Q1, and the lack of progress we've made on inflation. With that in mind, the ECB coming up next week after the Federal Reserve, looking for a 25 basis point hike from the European Central Bank. Still up in the air as to whether the Federal Reserve makes a move on Wednesday. Tuesday might be the deciding factor. We get CPI inflation data here stateside on Tuesday morning. Just to quickly touch base with the price action for you on the S&P 500, just about unchanged going into Friday's session. Absolutely unchanged on the S&P right now after closing yesterday in a bull market. Tom, tons of commentary about the narrow leadership, tech stocks doing the heavy lifting. Just a little bit more this morning about a broader conversation about maybe the potential of this equity market rally broadening out.
And certainly the June 30 reset of mid-year is happening a few weeks earlier here as the bears and those in cash. I'm not going to call the people in cash bears, but the answer is there's a humbled tone on this Friday.
Well, I can tell you the bulls. I just caught Binky Chana at Deutsche Bank out of the corner of my eye. And Binky's going to catch up with us, I think, in the next 10 minutes. He's looking for 4,500 on the S&P.
In the inflation report next week in the Fed meeting, what we're going to do is really focus here on the guesstimates forward. Right now, we are going to digress, and we are thrilled to bring you someone who runs an economy that is better than good. She's picking up a trophy in New York this evening. Nadia Calvino is Spanish Vice President, Minister for the Economy and Digitalization of #1 performing always, Spain in the continent of Europe. John, why is Spain always a #1 performer?
We're talking about football.
The pixie dust there?
We're talking about football.
Well,
Real Madrid,
football, or,
Barcelona.
Yeah, you know. I mean, there it is. But the answer is Spain is unique. We're thrilled that the Vice President could join us this morning. Thank you so much for joining us. I've got to go to the weather. IMF will meet in Marrakesh, and the idea is there is a drought in Africa coming over that will grossly destabilize the agricultural dynamo that is Spain. And quite frankly, there's worry about drinking water as well. How urgent is the drought in southern Spain?
Well, it is a very serious issue because Spain is a world superpower in the agri-food sector, and so the drought is having an impact on the harvest in some areas, having to do with cereal, for example. But drinking water is guaranteed. And we're investing very heavily, actually more than 6 billion euros, in the digitalization of water management and the efficient infrastructures for water management. You may know or not that Spain is the second most efficient country in the world after Israel in water management. And so we're heavily investing in that so that we can continue to be highly performant.
There's so many other issues. I'm going to leave it there, but there's much to talk about on that. I'm sure we will in the coming months. What has changed is you and Mr. Sanchez have a snap election to deal with. Our Alonso Soto says this is absolutely front and center. How will you approach the snap election?
Well, you know, the economy's performing is outstanding, as you rightly pointed out. It's better than good.
There? I read the notes. I did okay.
Yeah, you did very well.
Okay,
actually, it's better than good. And indeed, I mean, there's strong growth, strong job creation. Inflation is down to around 3% already in Spain. So the performance of the economy is outstanding. And I trust, you know, that Spanish citizens will actually.
But why is there a snap? I don't mean to interrupt, but this is important. The political turmoil in Spain is tangible. Why, given a good inflation and good economy picture?
Well, we had regional and local elections, and what we saw there was a rise of the right and, more importantly, the extreme right. This movement is not only happening in Spain. You were talking about it. Of course, it's relevant here in the U.S. It is happening throughout the EU, and this is a movement that I personally hope it does not continue. And President Sanchez decided to call the snap election so that we can have clarity. Spain will take over the presidency of the EU in July, and we need to have clarity and a stable government and not be, you know, in the middle of a campaign for the presidency.
There's still work to do before we get there. Vice President Calvino, one thing you mentioned there was the drought, and that's had an effect on price pressure. Now, you've made some progress on inflation. You do have an anti-inflation package due to expire at the end of this month. Is that something you're thinking about renewing?
Well, we're assessing which measures we should continue to have in the second part of the year and which do no longer make sense because the evolution in international energy markets, you were just discussing that energy prices have gone down. We are in pre-war levels already. So we have to see whether those measures should continue or not beyond June. And likewise for VAT, so indirect taxes on food and others.
Could you give me some insight on that now?
No, because we're in the midst of the analysis, and what we have been doing since the pandemic hit us is adjust measures every 3 or 6 months so that we could have a flexible approach and an efficient use of public resources. I mean, we talk about public money when we reduce taxes or we give public support, and so we have to be very focused and very efficient. This has worked well so far, and that explains why the Spanish economy is doing so well, and we should continue on the same line of responsibility and effectiveness.
How much have you enjoyed the euro being weak versus the dollar and sort of the tourism boom that has emerged on the heels of that?
Well, we've seen a very strong performance of the tourism sector indeed, and April has been a record month in terms of number of visitors and in terms of the revenues of the sector, and we expect the summer to be also extremely positive. But the current account surplus that Spain is showing, and this is a historical first, you know, never in history did we have this surplus, particularly when we have so strong growth. But what's remarkable is not the good performance of tourism exports, but non-tourism related services, showing that the Spanish economy is gaining competitiveness and market share. Not only the goods sectors, but the non-tourism related services are being, very positive and pulling growth up.
Is that what you're trying to emphasize right now? The sort of manufacturing side, the non-tourism side, even as the tourism side really is one of the main drivers of the strength that has in some cases been unprecedented in Spain?
What I think should be highlighted is what we're talking about is not just a bouncing back or a strong recovery from a macroeconomic or macro magnitude point of view, but that there is a structural modernization and transformation of the Spanish economy ongoing, which has to do with the new green economy, which has to do with digitalization, and it has a lot to do with the European funds, Next Generation EU investment and reform program. We have front-loaded that investment and reform plan, and the results are already visible.
Have you had a chat with Elon Musk at all?
No.
Should you have a conversation with him? Because he's reportedly in talks to build an EV factory in Spain.
Yes, I mean, we hear regularly, I should say, we hear about a possible battery.
Have you tried to reach out and have that conversation?
Well, I personally don't have a relationship with him, or I haven't had a chance to talk to him, but I am sure that the President's office is in contact with anybody that's interested in investing in Spain. Due to, thanks to the low energy prices, high penetration of renewables, and the competitiveness of the Spanish economy, we're attracting unprecedented investments.
Asking for a friend, I was in Washington, and the Dutch finance minister could not get us tickets to Vermeer. The whole team wanted to go to Amsterdam and see the Vermeer. Can you get us tickets to the Prado here with the Picasso opening up? I mean, 50th anniversary of this giant of Spain with El Greco. We need tickets to the Prado. Can we?
I mean, Tom, anything you need.
There we go. There we go.
I have a sweet spot
the last week of June from Madrid.
Vice President Calvino, Nadia, thank you. It's good to see you.
Thanks to
Fantastic
you.
to see you in New York.
Delighted to be here.
Thank you very much. Nadia Calvino there, the Vice President of Spain, with a lot on the table, a lot to sort out this summer, Tom.
This is, in America, this is an undertold story, and we know, I'll be honest, this all got jump-started by, of all people, Madonna, who started talking up Lisbon and Madrid as a place to be. And John, it is a boom emotion now in America. You go
Hang on a minute. You're saying Spain's known now because of Madonna.
No, the whole American investment thing to Portugal and to Spain came off one interview with Madonna.
What's Portugal got to do with this?
Two different nations.
No, it's people moving over there to the point where they've shut down some of the ability to buy real estate.
Oh, that's what you're talking about.
Yeah.
Like the golden visas to buy.
All of that. Madrid, and then you go down to Seville. And
I'm sure Madam Vice President can hook you up with a visa, Tom, if you'd like to purchase the property in Madrid.
We'll hear on the break.
Vinky Charter at Deutsche Bank on the equity market coming up shortly. I'm sure we'll watch the football, we'll get season tickets. Oh, great.
Great. Tapas.
Probably pay less in taxes versus New York at the moment.
That's right.
You see how much money you can save just by moving to Miami?
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Guy. Defending champion Iga Swiatek is just one win away from claiming her third title at the Clay Court Slam after she got past Beatriz Haddad-Maia in straight sets in her semifinal Thursday. She'll face Karolina Mukova for the title. Friday, Novak Djokovic faces Carlos Alcaraz in the match of the season. Watch it all exclusively live on Tennis Channel. Our coverage starts at 8 a.m. Eastern.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case that
it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
You have excess savings dissipating by the end of the year. You have student debt payments coming back. And so we think it's a consumer that looks a lot weaker by the end of this year.
We're in a world with higher inflation, and we've reset.
One conviction view that we have is this higher for longer narrative globally.
I'm still optimistic that the market is going to move higher by the end of the year into next year.
Ultimately, if you do go into a recession, bad news is bad news.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday on radio and television. We are resetting early for the mid-year look at June 30, resetting into an inflation report next week, into a Fed meeting next week, and resetting into a VIX, John, of 13.67, still a bull market unloved.
Binky Chowdhury at Deutsche Bank looking for more of the same, looking for 4,500 on the S&P 500. If robust earnings continue, capital return program should continue as well, and this equity market can grind higher, Tom, from here into year end.
It grinds higher, and the backdrop is interest rates, and there's a huge ambiguity here between three ideas. Interest rates stable, we're hearing that. Interest rates higher, we're hearing that. And there's a quiet group out there looking for substantial disinflation. I'd say they've had an off 10 days.
There are others who are looking for the long and variable lags to bite, and they've had an off 2023. They're sticking with it, though. They believe it's coming, and ultimately earnings are going to get hurt, Tom, later this year.
Tips percolating. I've had two guests this week talk about tips as being attractive. That inflation guesstimate, 1.54% on the 10-year tip, Lisa. And it's just out there is bond people seem to be hyper flexible now, trying to find the next trade.
And trying to understand where the distortions are at a time that people are betting on both immaculate disinflation, a tight Fed, and a sort of soft landing that delivers no pain. Something doesn't add up, right? Someone is wrong here. And so people are trying to arbitrage the places where there seems to be a little bit more consensus.
John, the confusion of the morning, you nailed us with Dan Ives and Tesla here. We got a Musk-Barra love fest.
Oh, big time.
Of a PE of 68, 5. I can honestly say I've never said that.
Tesla up by more than 90% year to date. Tesla, one of the big winners of the year, along with the likes of Meta and what's happening elsewhere with NVIDIA. These 5 names now make up about a quarter of the index on the S&P 500. There's been tons of discussion about narrow leadership, and Lisa brought this up a few times this morning, and we need to keep on building on it, Lisa. Are we seeing signs so far this month that this rally is starting to broaden out into the Russell, into the small caps, into other parts of equities?
The answer seems to be we're seeing signs. The question is how durable they are, and you're absolutely correct to bring that up because we are seeing the initial inklings that perhaps this is something sustainable. I keep going back to what Michael Purvis said, which is if you have fund managers that have gotten it wrong all year and they look at the headline number, which is distorted by this top-heavy AI trade, they're going to catch up with everything else, right? And so at what point does it bleed out by de facto?
Did we begin to see that this week?
Strip out the 7 on the S&P 500. Michael Hunt of Bank of America. The S&P this year's down. If you strip out the big 7, have we seen it this week? The Russell's up 7% this week. We've seen it this week. I don't know if we're going to see it next week and a week after that. Binky gets paid the big bucks to give us the answer to that one, Tom.
I'm gonna do a data quote here, John. I've got to do it in honor of Mr. Taleb. What a joy yesterday.
How was that?
It was spectacular.
I caught a bit, Tom. Well
we
done.
haven't seen each
Well
other
done. It was
in
great.
ages, and Nassim was heated. And of course, on Bitcoin at 26,000, he was scathing. There's no other way to put it. It's been a big, we haven't talked about it this week, but a big shift by Gary Gensler. What's the data look like, John?
Equities just about turning positive almost for a moment in time, now unchanged and slightly negative on the S&P 500. Yields a little bit higher by 3 basis points, 375. I think we'd all like a quiet session going into the weekend, Tom, and come out the other side and focus on CPI and the Federal Reserve after that.
At Deutsche Bank, for David Folkerts-Landau, setting the intellectual structure on equities and asset allocation. Chief Global Strategist Binkem Chadha joins us this morning with DB. Binky, you nailed the bull market. It took a while to happen. The Chadha market, the Chadha bull market took a while to happen. And with a vengeance, you nailed this. And when we were talking, going live here, you made clear 10% of the people have participated and 90% of the people have been left behind. What's the next leg look like for 90% of the people that have missed this October market?
Yeah, so, I mean, for them, and the distinction that I was drawing was, we've had to move up in equity positioning. So we have a simple sort of Z-score ±1 band. And, we were at the bottom last year. That was the reason for the call for a positioning squeeze. Positioning today is sitting in the middle of the band. But the entire move in positioning up has come really from systematic strategies, as vol has come down from extremely elevated levels to still very elevated levels outside, I would say, especially driven by really rates vol. Discretionary investors, which, in terms of assets under management, are, I would say, 8 to 1 in terms of relative size to systematic strategies. Their positioning has been what I would describe as firmly underweight for the last year in, a very narrow range.
Can I translate? Firmly underweight is polite shot attack for long.
So the participation has been, minimal to zero to non-existent.
Be nice,
this week, what we are seeing is basically some move up in what we put in our positioning measures, but it's really a sentiment indicator, and that's the AAII bull-bear spread, and that's moved up for the first time. Whether or not that actually translates into increased allocations, we have to wait and see.
The call from here, from where we are at about 4,300 out to 45, just reading your research last night from the last week or so, it feels like it's all about earnings. Can you pair this view about earnings with what's happening on the other side of the research team with Matt Lazzetti and Deutsche Bank ultimately looking for a recession? Can you pair the two views at the moment, Binky?
Oh, absolutely. So that's really easy because they are the same view. The view. So my earnings numbers tee off of our house economics forecast, but with a small twist, I would say. Remember that the S&P 500 gets 30 to 40% of its earnings from the rest of the world. So I have, a sales-weighted global GDP key measure, obviously, for U.S. equities, the U.S. economy matters a lot. We have a framework. I'm going to leave that aside for a second as to exactly what it is, but it tees off of basically our house economics forecast. So it's really a translation issue, if you want. It embodies a recession in Q4 and Q1. The things to note about it are that the forecast is for a pretty mild recession. Number two, we do have growth happening until then, and that means that the recession kicks in from a higher level in terms of earnings. What I would emphasize is that the equity market, when it looks at aggregate earnings, like the S&P 500's earnings, tends to look year on year. And year on year, we are still negative in terms of growth. It's slightly less negative than the prior quarter, but it's still negative. But remember that when we look at all macro series, we look quarter on quarter, which in equities we call sequential growth. And our estimate of sequential growth in S&P 500 earnings in Q1 on a seasonally adjusted basis is a solid 5%. And I would emphasize that's not annualized.
Markets are not the economy. And you have to just keep repeating that. Markets are not the economy. So John was mentioning that earlier. And I am wondering whether this could be the start of a bull market, even though the U.S. has not yet had a full-blown recession.
Yeah, so there's two sort of elements about the recession that I would emphasize. This is arguably the most well-telegraphed recession. Recessions, in my view, in terms of their impact on financial markets are not really about, a couple of quarters of negative growth where everybody agrees that it's modest and temporary, because the market's going to look through that. The market's meant to look through that. If you listen to corporates on earnings calls, we're at the point where we've been talking about recessions for at least the impending recession, basically, for at least 3 quarters. And so, corporates are, already responding, and the idea I would put on the table is that, it's very possible that the recession slowdown, part of that has already, been brought forward, if you want. If a recession is very well anticipated, it's not very, there's little shock value to make you risk averse. So there will be some negative impacts, but, a lot of the multipliers come really from risk aversion, and it's, the concept of anticipated risk aversion, an anticipated shock is not a shock.
Just to tie this all together and to end where we began, do you think that we are seeing durable signs of a broadening out?
I think that it gets pretty choppy from here, because the positioning squeeze that I spoke about at the beginning, that's mostly basically been done. I mean, as as Tom mentioned, VIX at 14 and 13, the biggest driver of systematic strategies is decline in vol, and we are not looking for, vol to really go down from here. We're not really looking for discretionary investors to raise their positioning, because as you said earlier, there's this very long list of concerns that they're focused in on. And I don't think the resolution of those is easy. So we're going to continue to have a tug of war, but the demand supply, the positioning squeeze is done, but the demand supply balance still looks, constructive. So I would say a grind higher, 4,500 by year end, but it should be pretty choppy.
Extrapolate out.
Soft landing will easily give you 5,000. Yeah, we've said that before. We published that before.
Binky's so measured. Binky had a tough year last year, same tone. Great year this year, same tone.
He had a
so
tough
measured
year
all the
last
time.
year because you make the call, but the x-axis you never know.
So the life of a strategist, Binky, just quickly.
Yeah.
Does it feel a whole lot better when things are going right, or do you get nervous that things are about to go wrong? Are you constantly paranoid? How do you think about it?
I'm constantly paranoid.
What is it like?
You're asking me this on air.
Yeah. What's your approach to that? Last year was tough. I've talked about that with you many times. This year is better. How do you approach things when you're right?
The same way as you approach them when you're wrong. You ask yourself, what have you got right? And I mean, are you right for the right reason? And what have you got wrong? And you adjust your view accordingly.
What was the lesson from last year that helped you with this year?
The lesson from last year was a confirmation of my view early in the year that we would get a massive amount of anxiety from the Fed, but the anxiety was of their own creation because they decided for a variety of reasons to wait a long time. So when I listen to the FOMC now, I hear calm. I mean, and that reaffirms my view that a lot of their nervousness, yes, about inflation, still about inflation, but you know they were at 0 to start the year. We're now at 5, and so there's a lot less reason to be anxious.
Excuse to get out of the triple leveraged all cash fund. I mean, first order, 100 shares of NVIDIA.
Hey, Vinky, this was great. Yeah. Tons of respect for you. It's always great to catch up. Vinky Chowdhury there of Deutsche Bank. Coming up on the Open, Mohammed Al-Arian. On the Fed next week, Daryl Cronk, Wells Fargo, Michael Cushman, Morgan Stanley on this market, Sarah Hunt of Alpine Saxon Woods. All coming up in the next hour on Bloomberg TV.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Relief is in sight. The National Weather Service says heavy rainfall in parts of the eastern U.S. on Sunday should help dissipate much of the smoke choking the region as a result of the Canadian wildfires. Air quality is already showing some signs of improvement, with the level in New York City returning to moderate overnight. Still, conditions remain unhealthy for many cities, spanning from North Carolina to Rhode Island. Donald Trump has become the first former U.S. president to be charged with committing federal crimes. A grand jury has indicted Trump in connection with his refusal to return classified documents found at his Florida home. If convicted, he could face prison or be disqualified from holding public office, including seeking to recapture the White House in 2024. Most economists expect the Federal Reserve to pause interest rate increases next week for the first time in 15 months and leave policy on hold through December. According to economists surveyed by Bloomberg, the Federal Open Market Committee will keep rates steady at its meeting at the 5 to 5.25% rate. Officials face a closer call on what to do in July. I'm Lisa Mateo, and this is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. This Wednesday, will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment.
And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Mr. President, what do you say to Americans to convince them that they should trust the independence and fairness of the Justice Department when your predecessor, Donald Trump, repeatedly attacks it?
Because you notice, I have never once, not one single time, suggested to the Justice Department what they should do or not do relative to bringing in charge or not bringing in charge. I'm honest.
And that will be replayed in the coming months, and particularly Tuesday of next week, when we are supposed to have a summoning of former President Trump to a federal court in Miami. Tom Keene and Lisa Bramlett's with us. We've talked a lot this morning about this news that occurred last night, the appearance by President Trump as well. We're going to digress from that right now because this is important. There's times where you stand at Bloomberg and two people are talking and you go, well, this I really need to listen to. Amory Horton yesterday in conversation with a gentleman out of New Trier in Chicago, Auburn, NROTC, shockingly competent with the United States Navy in our intelligence efforts abroad. And Amory, I want to focus with your conversation with Admiral Rogers on the Pacific Rim. I was spellbound by the acuity of the discussion. Tell us about it.
Well, I think what was so interesting speaking with Admiral Rogers is because this is an individual who has nearly 40 years experience at the Navy. And when you talk about and just see headlines about, say, a U.S. warship in the Taiwan Strait coming very close to a Chinese vessel, you potentially think, how does this happen? How does this work? And he actually can explain to you, because how ships move so slow, the distance between that obviously had to be a provocation. He's able to take these moments we are seeing in time and extrapolate them and explain why it matters so much at this moment to a business community. And I think really for him, what he sees in the national security apparatus is it's no more just about hardware and the military, that you actually need individuals with top-notch economic minds when you're trying to deal with the geopolitical issues of today, not just China, but also what we're seeing in Russia.
What about the geopolitical issues of the Beltway and Washington? I mean, we're not asking the Pentagon to solve the firestorms of Quebec, but is the Pentagon, within your reporting, feel like they're on their own because of the gridlock and the political debate to the election in Washington?
I don't know if I would say they're on their own. I think the Pentagon has always tried to take a above politics approach. Obviously, they're in the news very much this week, last week, because of all the talk around Congress and the White House regarding the debt ceiling drama in that bill about caps on where you want to have defense spending. And that's going to be a huge story going into the end of the year, because to get that bill over the Senate, you had defense hawks basically being promised they're going to have supplemental bills to make sure they can get more money to the Pentagon, and McCarthy saying that might not
Lisa,
fly.
that's Anne-Marie Horton talk. And the answer is Admiral Rogers was talking yesterday, and you felt like you were on one of those two boats.
Yeah.
In the Taiwan Straits. I mean, it was stunning to get away from the Beltway blather to somebody who actually knows what they're talking about.
War is cold and soft. All others are won by logistics, not by anything else. It is about the actual tangibles of the experience. And I do wonder, this is where everyone's focus actually is on, even in the investment world. I was speaking to someone yesterday who was saying it isn't the Fed, it isn't these sort of economic figures, it's geopolitics, and it's what we track forward. How concerned was the Admiral about what is transpiring, how we are sort of shaping up right now?
Well, me and the Admiral joked, and Tom was there. He heard it. It was quite a depressing conversation if you're looking at all the geopolitical risks that are emanating around the world right now. Obviously, there's Russia, invasion of Ukraine. Where does this lie? What does the future of this look like? He brought up the fact that maybe this becomes a frozen conflict. I think more people are starting to feel that that potentially is going to be the end of this. It just doesn't end, but it just doesn't become a hot war.
We call that World War I.
let's hope not.
And then obviously China. And this for the business community is paramount, right? Because the economies of these two countries are so ingrained. The trade is at all-time records. They have tons of investment in China. And really what so many strategists and individuals that look at geopolitics and implications for the economy are trying to learn about the lessons from Russia and what that could mean for China.
We're talking about this, and it sort of is a digression from the news of the day in terms of the potential Trump indictment, according to sources that we have not yet seen the full documents of, and what that means for the whole Republican election. I am wondering, though, how that does dovetail into the U.S. perspective internationally. How much of the theater in the U.S. actually does have a material difference to what the rest of the world does with its dealings?
Well, listen, the rest of the world, and I've spoken to a number of individuals abroad, they are so focused on 2024. They have individuals in the United States, even traveling the country, trying to figure out what the U.S. will look like come November in 2024. Who will be the next president of the United States? Is it another President Biden? Is it another President Trump? Or is it someone else? And this is incredibly important for Western allies. It's incredibly important to the decisions they make now in terms of how they are going along with the U.S. when it comes to things like China. And then for adversaries, they want to know, say you're Putin, will you want to know whether or not the Ukraine aid will continue at the level it has, or is that going to be pared down?
In the zeitgeist in the last 3 days, and I'm sorry, folks, I can't cite it. I don't have it in front of me, but I'm clear that I saw some form of article, mini article, that the White House is out talking to cabinet officers about what's your plan. Should we expect announcements over the week in Axios over the weekend into next week? Are we going to see ya from cabinet officers?
I don't think this is anything we're going to see immediate. What you see from the chief of staff, Mr. Zients, is that he doesn't want to deal with headaches at the moment when they're going into an election campaign. Because remember, if you're a cabinet posting, you need to go through the Senate. And these could be long, drawn-out processes, and they want to remain focused. So I think his message was, if you do not plan on staying till the end, give us the courtesy and be gracious and leave sooner rather than later. Stan
Druckenmiller said to Shonali Bassick at Bloomberg Invest that he's rooting for the governor of Rhode Island. Is the Commerce Secretary, Ms. Raimondo, is she a potential candidate?
I think
of some form?
When you look at how Secretary Raimondo conducts herself and her CV alone, this is just based on looking at her and talking to people who really do like her. She has great respect within the business community. She is someone that they pick up the phone and call. She was a governor. She's now a cabinet post. I think you can look at her and say, this is an individual who has higher political aspirations.
What's going to be the Sunday talk show discussion around Trump?
Trump. That's it. It's going to be all Trump. Whether if we get the indictment,
let's hope.
Let's hope it's that the Yankees are beating the Red Sox. But I think on Sunday, it really depends if we do get the indictment text today, right? And that.
We could get it today.
Yes.
I did not know that. Okay. Yeah. That would be interesting. Fascinating. Emery Horton, thank you so much. And again, congratulations on just a riveting discussion, folks, with Admiral Rogers, Navy retired, here on what we're doing in the Pacific Rim. Lisa, we got to go through the data, which tells you it's, to borrow from Greenspan, somnolent, oil at 71, West Texas Intermediate, DXY doesn't give you much love. But I just go back to the VIX under 14, and that colors every conversation. This bull market that's slipped up on a lot of people, as Binky said, who are not in the bull market.
The somnolent rally to a bull market, right? I mean, that seems to be what we've been doing, although it has not been somnolent in the tech shares, in the AI-related shares, and that seems to be what's driving everything.
Well, I mean, it's there, but there's been maybe a bit of rotation. It sets us up for an interesting June and really gets us to that key data point. I believe it's June 13th, the inflation report.
Yeah, which, again, let's see how much that actually changes the game, because right now we're looking at people who are basically pricing out rate cuts. It doesn't seem to really matter for equity valuations that are driven by this hype and this belief in American dynamism and what we're going to see with the AI developments.
We'll have to see, and I'm also going to point out we've been very quiet on housing, which has had a respite from 7.15% down to 7.05%. 30-year mortgage, maybe we'll get that to move up higher. This conversation will continue, and coming up with Citigroup, he has been dead on about higher interest rates. Hollenhorst of Citigroup. Stay with us on radio and television. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg Surveillance, good morning. Again, an inflation report. We'll see that next Tuesday as well. We're adapting on a Friday to not being in the market. Triple leveraged all cash fund. Missed that puppy, didn't I? Red and green on the screen of VIX 13.65. And because of the importance of this conversation, you know what? We're going to truncate the data check. And Lisa's got intelligent words from the guy at Citigroup who was so right.
Well, this has been really the big debate. Everyone sort of priced out the idea of further Fed tightening after what happened in March, and he stuck with it. He said that the economy was still strong, and here he comes today, Andrew Hollenhorst and the team over at Citi, still maintaining their call that next week is not off the table. The Fed is going to raise 25 basis points, writing, quote, the Fed remains on track to revise up GDP and core PCE inflation projections and lower their forecast for the unemployment rate. Dots for 2023 will need to move higher to avoid communicating that policy is unresponsive to data. In our base case, the Fed will hike 25 basis points and raise the 2023 median dot by at least 25 basis points. How do they do this, Tom? without surprising the market, which is something that they don't want to do in a disruptive way.
Or how the market adjusts as well. It's dovetailed the finance and the investment part of this into the economics of Andrew Hollenhorst, chief U.S. economist at Citigroup. If we get a Hollenhorst call here and you've been shockingly dead on, what does the 10-year yield do? Should amateurs just assume the 10-year migrates up to a Hollenhorst level, dare I say, 4.5%, even 5%?
Well, I think you're zeroing in on exactly the issue for the Fed is they keep pushing higher with policy rates, but it's very hard to get traction on the 10-year yield. It's not clear at all that the 10-year yield would move significantly higher, because the more the Fed raises policy rates, the more the market is going to price that the U.S. economy will go into recession, that inflation will come down, and that the Fed will be cutting rates. So the Fed really has to communicate both that they plan to continue raising rates and then they plan to continue to hold them there. They're trying to communicate that, but that's not coming through to the market.
So this is critical, and I go to Anna Wong's wonderful work on Chicago with Bloomberg. Her brilliant call dovetailed with you and, frankly, Dudley of the New York Fed, now writing for Bloomberg Opinion, which is all of a sudden the time continuum matters. It's not about going from this level to that level. How have you adjusted the longer at a given rate?
Yeah, so I think that's really the margin that we might see the Fed trying to play with more now, because it is the case that policy rates are getting to levels that are close to restrictive. A lot of last year was about getting to that restrictive level. We're probably not quite there yet, but there's a sense that we're getting close. So now the Fed is in a much more difficult scenario, I think, because they have to guide to keeping rates higher. They can do it with the dots. That's what Lisa was mentioning, that the 2023 dot can come higher. I'm not sure that they're going to do it at this meeting. A way to strongly guide that you're going to leave rates higher for longer is to raise that 2024 dot to indicate that in 2024 you would actually be leaving rates higher for longer. I'm not sure they're there yet.
Bramo Cam's over here. She's laughing at me.
Well, I know.
She knows how much I disagree.
Well, no, instead of talking about the dots, the signaling between moving this one up and that one up, why not just raise by 25 basis points? And that seems to be your view. That sends a pretty strong message. And yet that would go against historical precedent for this Federal Reserve that is not looking to surprise markets and has signaled every which way they're going to pause.
So look, to your point, the simplest way for the Fed to indicate a hawkish or dovish bias is to do something. And that's always been the case. That continues to be the case. Raising 25 basis points next week would be a very clear way to send that message. It's not that big of a surprise for markets if they were to, for instance, raise 25 basis points in June and signal maybe they would skip July. Well, we have about 20 basis points priced for those two meetings. So maybe it wouldn't be a huge surprise in that respect. Remember, we also have a CPI reading upcoming. But I think you're focusing on exactly the right thing, that it's very hard to get markets and the public to buy your guidance for what you're going to be doing sometime in 2024, because there's so much uncertainty. What you can do is to do something today, to do something next week. That would be a strong way to send a hawkish signal.
One of the biggest divergences right now among the people who we speak to is what they believe inflation is doing, whether they do believe it's stickier, whether there's going to be this sort of disinflationary kind of trajectory that we've been hearing about from a number of different shops. I'm just wondering how you view the market's reaction if the Fed does not hike rates next Wednesday. Will you see a bleed up in yields in the long end, a sort of unmooring of inflation expectations?
I think you could. I don't know that next week is going to be the pivotal moment when markets kind of realize that maybe inflation is going to stay persistent for longer and the Fed's policy isn't going to be as effective as has been priced in. But you go back to just the basics of how they're going to adjust the forecast, like you were talking about, with GDP growth coming up, with core PCE inflation being revised up to some extent. Just raising the dot for 2023 25 basis points, if you're revising up inflation 20 basis points, that's just kind of staying even with where you were. If you don't do that, it's actually dovish.
I'd love you to comment on what we were talking about with Kathy Jones from Charles Schwab about this idea. What does it tell us that the economy has been so resilient, even though the Fed has raised by 500 basis points? Does it tell us that the long and variable lags, as John said, are longer and possibly more variable? Or does it tell us that this is an economy with way more momentum than anyone had ever imagined?
Yeah, I think the issue for the Fed and the issue for all of us analyzing this is that probably both of those are true to some extent. So you've seen in the housing market, we've already had the maximum power of tightening, where we got mortgage rates higher, we got housing activity that slowed down, but now it's bottomed, now it's coming off that bottom, now house prices are coming up again. So in that sense, it's not a lag issue, it's just that the power that was in the economy was too great to be overcome by 500 basis points of rate rise. But then you also have a lag issue. And I think if you think about what's happening with the banks, for instance, we do expect some drag from that tightening. But that's going to play out with a much longer lag. And that's, going back to March, I think some people were looking for an acute tightening of credit conditions. That didn't happen. We didn't have the acute credit crunch. That doesn't mean that we're not going to have more restraint on bank lending, but that can take a year or longer to really flow through to the economy.
Michael Woodford, Interest in Prices. You're the only one I know who's ever read the book. It's 948 pages, and everything there is about convergence, about this. Right now, getting to Tuesday, core CPI with 3 exponential moving averages is converging to 0.4%. That's a lot of math talk where we've really reached a stasis on inflation. What could that signal for you Tuesday if we break out of that convergence?
So I think that's what we're all looking for on that Tuesday. Does core CPI inflation come in 0.4%? That's about what the market is expecting. That's still well above the 2% target, though. That's close to 5% annualized rate of inflation. So 0.4%. I think we still price some probability that the Fed hikes. Maybe they do. Our base case is that they do. If you surprise to the upside, though, if we surprise to the upside and we get a 0.5% reading, and even if that's because it's used car prices that went up more than expected, I think just optically it becomes very hard for the Fed not to hike.
What about the other way? We go the way of Ed Hyman and David Rosenberg. They don't agree with Andrew Hollenhorst. If we break to 0.3%?
0.3%, and there you could have a
I've
Fed.
never had this conversation. This is how stupid this conversation is.
It is where we are. It is where we are. 0.3%, and the Fed may point to that. They may point to the rise in the unemployment rate, right? And that we're really kind of, picking and choosing our data here and say, you know what, we're going to skip in June, but we're probably going to be hiking in July. Now, I think that's a lot harder to communicate, but they can pick and choose and do that. It was so much more
intelligent. Greenspan's carrying a ham and cheese sandwich. What's it mean?
Yeah, that was that more intelligent.
Yeah.
The problem here is we don't understand the parameters. I keep going back to that. We don't know what economy we're going back to. We still are dealing with pre-pandemic or really post-pandemic distortions that are creating long and variable lags with respect to the stimulus as well as with respect to the Fed tightening. Do you have a reset expectation of the parameters we're going to settle out in? Will it be a higher inflation environment with perhaps higher interest rates for a longer period of time, or are we going to rapidly disinflate at some point far out there?
I think the risks are that we end up in a more inflationary economy, and you heard Bank of Canada officials talking about that yesterday, this idea that inflation just structurally can be stronger now. And we're seeing some of those indications already. Some of this is geopolitical. Some of this is just the fact that we now have a more supply-constrained economy, and we're really not used to that. For many, many years, we had an economy where there was plenty of supply, and the issue was demand. Now we have these more real supply shocks, and that's going to be a more inflationary world.
Are higher rates stimulative on the edges? Basically, that people can actually earn something from their money, and then also you're getting, just nominal growth in revenues that will help foster some of the dynamism and won't necessarily create this relationship that everyone thought yields up, price of everything, risk down.
Yeah, it's a great point. I mean, there are winners and losers when interest rates move higher. There are distributional consequences. You're moving income around within the economy. But the net effect is still a tightening. I think the net effect of higher rates, even though savers will do better, borrowers, it will be more difficult, the net effect is going to be a tightening.
From where you sit, and we've had a glorious week here talking equities, including Citigroup equity as well, how do you link your economics to your equities strategist? I mean, I know you guys don't talk to each other and all that, but how do you link your world to the stock market world?
So, I mean, we talk regularly, and
Greenspan made a big deal about this.
Yeah, we talk about whether you can reconcile what's priced in fixed income markets, what's priced in equity markets, and what the outlook for the economy is. And I think the way you can best reconcile the three is to have an outlook for some kind of a soft landing. And unfortunately, that's not my outlook. That's not most people's outlook. But it is hard to see how you're going to sustain very low levels of equity implied volatility, high levels of equity prices, and have a Fed that is fighting inflation that remains persistently too high.
I mean, the inflation call that you've had is brilliant. And to Lisa's point, at some point, it breaks out there. What will be how does the Fed, we've never been here before. The Fed has raised rates as we've never seen. We've never had an analog where they have to cut rates after that kind of first derivative move. We've never seen this.
Yeah, and it goes back to what we were talking about before, that Fed officials, I think, will be quite reluctant to cut rates. It doesn't mean that they won't. Once you see clear evidence that the labor market is loosening, that inflation is really on a downward trajectory.
What's your unemployment rate to make that point happen?
I think they certainly need to be
above 4,
and probably above 4.5%. If you look at their own projections would have had unemployment at 4.5% at the end of this year, and they still would have been holding rates.
So what's that on a non-farm payrolls basis? Do you have to have negative non-farm payrolls?
You need to have negative non-farm payrolls. 339,000 new jobs is not going to do it.
That's a Hollenhorst statistic, the way down. Congratulations on just an extraordinary and persistent call here of what this Fed has done. Mr. Hollenhorst is with Citigroup. Red and green is, Lisa, there's a lift to the market. Hollenhorst driving the market higher.
I don't know if I would really characterize it as that, basically saying the Fed will be more hawkish. But yeah, there definitely is. The melt up, the melter of all melt ups, as Ed Yardeni said.
Coming up, lean forward, Jeffrey Curry, Goldman Sachs on oil.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Relief is finally in sight. The National Weather Service says heavy rainfall in parts of the eastern U.S. on Sunday should help dissipate much of the smoke choking the region as a result of those Canadian wildfires. Now, air quality is already showing some signs of improvement, with the level in New York City returning to moderate overnight. Still, conditions remain unhealthy for many cities, spanning from North Carolina to Rhode Island. Tesla shares are poised to rise for a record 11th consecutive session, matching the stock's longest winning streak set in January 2021. That after General Motors said it would adapt its electric vehicles to Tesla's superchargers. It follows a similar move from Ford. Tesla shares have risen more than 90% so far this year. Former Barclays CEO Jess Staley has been out of sight for more than a year and a half as the revelations about his relationship with disgraced financier Jeffrey Epstein piled up. But in New York this weekend, Staley is scheduled to give his version of events for the first time. A pair of lawsuits allege he witnessed an assault on a young woman and may even have participated in a sex trafficking ring run by Epstein. Staley's lawyers deny those allegations. OD Asset Management is in talks with some of the world's largest investment banks, hoping to convince them to stick with the London firm. Several began distancing themselves from OD after new allegations of sexual assault surfaced against hedge fund manager Crispin Odey. Morgan Stanley is cutting ties, while JP Morgan and Goldman Sachs are said to be reviewing their links with the company. OD CEO Peter Martin says the firm's lawyers are looking into the claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. In a a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Actually, I've been a critic of Bitcoin. It's a fad. I mean, the claims they make that they're a refuge are false. That they're good for transaction is false. They're not even attracting the bad guys anymore. And you know that the Federal Reserve can very quickly replace these cryptos.
My first project with Bloomberg, even before I wandered into the building, was with a guy named Dylan Radigan, long ago and far away. Dylan Radigan called me up and said, we've got this guy who's a quant guy, and he's got a book out. Is this going to be a big or a small deal? And I think they had to move the venue 4 times because 1,200 people showed up for Nassim Taleb. I will tell you what I finished yesterday at Bloomberg Invest. Here's where you start. Fooled by randomness is what started it for Nassim Taleb. There is no one I know in our universe who has published so consistently and so excellent and there with his heated opinions on Bitcoin. Jeffrey Curry's going to come out with his version of Fooled by Randomness on oil, global head of commodity at research at Goldman Sachs. Jeff Curry, I say this with immense respect for your bulletproof University of Chicago microeconomics and econometrics. How did oil fool you by its randomness in the last 12 months?
Well, I have to say, we have never been this wrong for this long without seeing evidence to change our views. Obviously, some of the upside has been taken away by recent events with, the sanctioned oil surprising to the upside, whether it's Iran, Russia, Venezuela, and more destocking. But the core thesis still very much remains intact. And I think one of the big drivers is, you've lost 250 million barrels of paper linked in this market. We're back to where the market is as short as it was during COVID when we saw negative prices. And you've erased the overall length going back into the early 2000s. And I chalk this up to, ultimately a broad, what we call the great destocking. High interest rates are forcing destocking of physical barrels, destocking of sanctioned barrels, destocking of SPRs, destocking of finished goods, even destocking of financial paper barrels. So we have been just continuously selling for about 6 months to 9 months now.
Can you elaborate a little bit? Because for people who are not in the nitty gritty, a lot of what you said was perhaps a bit opaque. The connection of high interest rates to a lack of interest in buying oil on a whole range of areas, or a lack of sort of stockpiling physical or paper crude.
Let's go through the economics. Let's say to borrow money today to buy a barrel of oil, because you got to, finance your physical inventory. Let's say it's 7-8%, somewhere like that. LIBOR is paying you 5.25%. That's your opportunity cost of putting your money into a risk-free investment. So your net cost of holding physical inventory runs somewhere around 13, potentially even 15% in this environment. Why are you going to do that? You've got NVIDIA and NASDAQ going up. There's so many better places to put your money. And I think the other point too, oil, copper, and the rest of these markets don't have a positive carry. So they cost you to own it, cost you to store it. You're going to drain down these inventories as much as you can. So oil, copper, they are a liability right now. They are not an asset. And until they become an asset, no one's going to want to hold them in an inventory or hold them in a paper form. And so you could just think about that the cost of holding these commodities has risen so much that ultimately you're destocking. Now, we've been waiting nearly a decade for the Iranian floating storage to discharge. It's finally discharging right now, which tells you nobody really wants to hold, this commodity. We think that's going to change, and I think it has to start with lower inventories, forcing what we call a backwardation, which is a positive carry in the curve. Then somebody will want to own it.
This is fascinating because for years people were decrying the financialization of crude as sort of a bet on the macro economy. Are you saying that it is no longer in the same kind of way, that this is basically where it is traded, but it's actually a liability now that the financialization has come to such a place where people look at it as comparable to an interest-bearing type of instrument, and you're waiting for some sort of, not I want to say crisis, but a complete lack of inventory to spur prices in such an extreme way that you get a violent shift up that really forces the hand of people who are left kind of in the dust?
I'm not going to say it's 100% interest rates. It's fear of recession, why people don't want to own these. The government discharged their reserves due over fears of inflation. So there's other factors at play here, but I think your broader point is absolutely right. We think about, when was oil financialized? In the 2000s, when interest rates, it was right after September 11th in 2001, when interest rates first went to near zero. That's when you started to see the explosion in the financialization of oil and commodities. And we stayed into this, this loose money environment for nearly 15, 20 years. And now money costs something.
There are a set of world-class leaders, and you're one of them, Jeff Curry, on this, and with the acuity of the, what I'm going to call almost the general equilibrium theory of hydrocarbons. You parachute into Riyadh right now, and you have to advise the Saudis on the elasticities of supply and demand around this new world, which is the old world of a cost of money. How do you advise Saudi Arabia in this new world of higher nominal and real interest rates?
Their market power has never been higher. And one of the reasons why is you combine the higher cost of money combined with issues around the cost of funding hydrocarbon type of investments. They're the only game in town. They have no competition right now. When we look at the cut they made in October, that was the very first preemptive cut we've ever seen OPEC do. And we just saw 2 more cuts announced in the last, the last 3 months. Why? Because they don't have fear of competition. Yes, the oil that's coming on market is things like inflation fighting, which is why we saw such a sharp rundown in the SPR. And you're talking, you put all the SPRs together, it was 250 million barrels drawn down. That is a lot of oil. So I think the focus from a policy perspective is get the inflation down and keep it down. But here's a fact I like to throw out. You look at core CPI, it's somewhere around 5.5. It was at that level, going back nearly 2 years ago.
Yeah.
What's changed is oil prices went down, taking headline from 9 down to 4.5.
Just quickly, Jeff, do you think that that's the reason why the U.S. is not refilling the SPR more aggressively, because they're still concerned about inflation and that could, on the margins, push prices up?
Well, I think with, the showdown over the debt ceiling, getting money to go buy oil would be really difficult to come by. But that aside, listen to France, listen to Germany. The focus now is building strategic reserves of green metals, like battery metals, like copper, lithium, cobalt. So if you're going to build strategic reserves, you're probably going to do it in, the green economy commodities, not in the old economy commodities.
Jeff, where's oil in a year? I know it's an unfair question given all the ambiguities out there right now, but I've got to ask. I mean, we're down, right, wrong, whatever. Scope out where we are in 12 months.
Yeah, our view is you're going to see substantial physical inventory draws because of these OPEC production cuts, particularly during third quarter as well as in fourth quarter. That's going to push us up into the low 90s. Now, the question is, will you bring the class of investor? It take that investor buying to push you back up towards 100. We're not, I know a lot of them have gone left and it'll be difficult to get them back. But I think the key question, fundamentally, we can get this market higher. And I think if we get, once you turn oil into an asset, you'll attract capital back to it. But I don't think it's going to be the same cast of characters.
Jeffrey Curry, thank you so much. Just absolutely brilliant there with Goldman Sachs. And Lisa, this really rolls over to Sonali Baskett's conversation yesterday with Mr. Waldron of Goldman Sachs. They're both talking about what you've talked about so much, Guess what? The world's changed. There's now an interest rate. It affects equities, bonds, currencies, commodities, and West Street downtown.
It was just fascinating. I really want to spend some time thinking about what he just said, the financialization going into reverse of the crude market.
In the next hour, Mohammed El-Arian is on. He's not with Bloomberg Surveillance. He's with another show. Stay with us on radio, on television. Good morning.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Let's get you to the weekend. Your equity market on the S&P 500, just about positive. Back in a bull market. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the S&P 500 back in a bull market, GM delivering another win for Tesla, and Trump charged over secret documents. We begin with the big issue. The bull market is back, fueled by a tanker full of pessimism. The S&P 500 rallying more than 20% from an October low. And the bulls think there's more to come. Deutsche Bank's Binky Chada looking for 4,500, suggesting that while the move up in positioning this year looks done, if earnings remain robust, so will buybacks, and equities should continue to grind higher. As not even 3 of the biggest bank failures in this country's history have been enough to hold us back, big tech has been picking up the slack, and big tech just keeps getting bigger. The 5 biggest companies in the S&P 500 now accounting for a near record 24% of the benchmark. Bank of America's Savita Subramanian pointing out that Apple alone is now bigger than the Russell 2000. Elsewhere, the bears are still clinging to positions they've held all year. Morgan Stanley's Mike Wilson insisting the boom-bust period that began in 2020 is currently in the bust part of the earnings cycle. JP Morgan's Marko Kolanovic saying the consensus view that the worst of pressures is behind us will likely be proven wrong as the impact of monetary tightening worked historically with a lag and certain growth supports are waning. To discuss the closeout of the week, to start this programme, I'm pleased to say that joining us now is a good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's start there. Just how long and variable are these long and variable lags?
Well, let's start with a good week. It's been a calm week because next week will not be calm. Look, no one knows, John. Absolutely no one knows. There's a whole set of theories out there, some suggesting that the lags are quite short now because the market does all the heavy lifting for the Fed. The others that suggest that the lags are long, maybe 12 to 18 months. So we simply don't know. And I'm going to keep on repeating that there's lots of things we don't know and that we're only going to discover over the next 6 to 12 months.
One thing we do know over the last 48 hours, Mohammed, is that we've been whipsawed by 2 things. Surprise rate hikes this week, the RBA down under in Australia, our northern neighbours up in Canada, and then on the other side, whipsawed by soft economic data, jobless claims yesterday, showing some signs of breaking out. From your perspective, what are you putting more weight on right now? The surprise central bank decisions from elsewhere or the disappointing data we saw yesterday morning?
So I tend to put more focus on the former, on the surprise move by the central banks in Australia and Canada. Those are 2 central banks that had paused and now are back hiking because the data, not only the underlying data that suggests that inflation is sticky, but what they see ahead suggests that the inflation is going to continue to be an issue. So I put more emphasis on that. Having said that, I don't dismiss the jobless claims, but you know that jobless claims, this weekly series, is inherently noisy. So one would need to see the next 4 to 6 weeks to get a better feel.
I was looking at some labour market expectations and forecasts from Ellen Zettner of Morgan Stanley. Mohammed, her and the team are looking for 4% unemployment 4Q23. They're looking for 4.4 in 4Q24. Their expectation for unemployment is 12 months further out than where the Federal Reserve is at year-end. Year-end, the Federal Reserve's at 4.5. Morgan Stanley and Ellen Zettner get close to 4.5 12 months later. Mohammed, it's not just the decision that we're teeing up for next week, it's the projections as well. What do you think those projections are going to look like over at the Fed?
So I think they're going to correct yet again. You know, they've been too pessimistic on the unemployment rate. And I think that they're going to correct that because I don't see us getting to where they think we're going to get by the end of the year. I think the unemployment rate will be lower. I think they're going to correct their inflation forecasts and they're going to take them up yet again. John, if you talk about the labor market, keep an eye out for wages. Wage growth, depending on what you look at, is steady at around 5%. And that is too high for a 2% inflation target.
Would you expect that median dot then to come up in the dot plot on Wednesday?
Yeah, I do. I think they'll go there, but it's going to be, the press conference is going to be absolutely the most interesting element of next Wednesday.
What is it about the presser that you think is interesting?
So first, let's see where we start from. They have guided the market. As you know, a top Fed official guided us to expect a skip. And that will make sense if Tuesday's inflation data comes in well below forecasts. Why? Because this is a highly data-dependent Fed. Having said that, they haven't dealt with the larger framing issue. And you're not going to get me to front-run my FT article again. I'm going to have to wait till Monday. But there's a larger framing issue that is not being looked at. So how they describe that the skip, which the market expects, is going to be critical. Now, if they don't get favorable inflation numbers, they're in a really hard situation because they will have to surprise the market. So it's going to be next week is going to be absolutely fascinating. Tuesday, Wednesday is going to be probably the most interesting 24 hours a little bit more, 36 hours that we've seen for a long time.
Well, you've got to give us a sneak peek now, Mohammed, because once you've publicised a different publication, the fair trade is to just give me a sneak peek of what's in that piece that comes out next week.
I think we've lost audio, John. I'm just kidding. No, I'm going to talk a little bit about how none of the three options being discussed, pause, hike, or skip, is an optimal one. Of the three, skip is probably the least optimal one. And the problem is that there are two much bigger issues. One, as you know, you and I have talked about this, what is the right inflation target for this economy, given what we're seeing on the supply side? That's an issue that has to be discussed in a very comprehensive manner. It's critical because if you've got the wrong inflation target, you will cause unnecessary pain to this economy. And then the other issue is how you make policy.
Well, let's build on that a little bit more, because, Mohammed, you've said repeatedly that they might have to tolerate a higher inflation rate going forward from here. You've also mentioned several times that ultimately, if you design that inflation target today, it wouldn't be 2, might be closer to 3. I caught up with some former colleagues of yours, some friends as well, over at PIMCO earlier this week. They put out their secular outlook, Mohammed, and they mentioned tolerating 2-point-something inflation. That's only part of the story. The other part of it is the appropriate time horizon looking out to just keep forecasting 2. Forecast 2 and accept something higher than that. Mohammed, how do you think about that dynamic now?
So the most likely path is that the Fed will keep on pushing back the 2%, still promising us 2%. We will get to a 2% target and tolerate something higher on that journey. That's the right approach to the journey, because if it tries to get us to 2% quickly, we will have an unnecessary recession and we will have unnecessary financial instability. So it is the correct thing to target higher than 2% for the journey. The big question is the destination. Is 2% the right destination? And the way we're going to get out of that is during the journey, we're going to find out that 3% inflation is stable. And if 3% inflation is stable, then the transition to a 3% target becomes much easier.
So how much damage do we need to do to the economy if 2% is still the goal and they remain committed to that? That's something we've discussed for the last 12 months. Chairman Powell, at the end of last August, talked about the pain that we need to see over in Jackson Hole, in the economy and the labour market, to get inflation back to target. Mohammed, I just wonder how decent a case study of Europe is right now for our current situation here in the United States. Europe had no growth in Q4, it had no growth in Q1, and inflation is still a problem. Guy Johnson and myself were talking about this time yesterday. Mohammed, what can be learned from Europe's experience with inflation and negative economic growth over the last 9 months?
Not very much for the US, because the US has two huge advantages relative to Europe. They are less prone to an energy crisis, and they don't have the massive food price issue that Europe has. So I don't think you can extrapolate. You know, John, you've heard me say over and over again, and there's no need for the US economy to go into recession. You've heard me question all these recession calls that keep on being pushed further and further back as growth proves robust. There's no need to go into recession. The only reason we'd go into a recession is if we get another Fed policy mistake. The US economy is vibrant. The labor market is doing very well, and there's exciting productivity enhancing technology being put to work as we speak. So the only reason you push us into recession is because you're pursuing the wrong target without being brave enough and open-minded enough to ask yourself, if I started today, what would be the right inflation target?
There's a big treasury market question in that as well, Mohammed, so let's finish there. Do you think yields should be higher on the prospect of inflation being sticky and tolerating more of it? Or should bond yields be lower at the lower end because of the growth risks associated with trying to achieve 2% inflation?
Yeah, so that all depends on what the Fed does. If the Fed tolerates 2 and something, as you put it, as my PIMCO friends and colleagues put it, there's no need to have a recession. There's no need to have bond yields collapse, right? And I could see bond yields staying here going higher because we also have a supply issue, as you know, from the fiscal side.
Mohammed, final question. We've talked about this over the last couple of weeks together. The Federal Reserve, you said 25, they're going to hike. I've played fair. I've said, you know, based on the information we have so far, we've still got CPI still to come. Where are you now?
So I thought your final question would be Manchester City versus Inter Milan.
I was going to get to that, but let's finish here.
So your final will be that?
That'll be my final once we've dealt with the market and the bond market stuff.
Look, it's very hard to project something different from what they've guided to. If they end up doing something different, John, their credibility will be hit. So the market, you saw the market is probability of a hike next Wednesday is down around 20%. It used to be 70% before they guided us to the skip. So, you know, the Fed now has got to deliver that. And its big hope, everybody's hope, is that the inflation data comes in well below the consensus forecast.
Was that yes to a hike?
No, they're going to skip now and hike after that.
Okay, so July for a hike. Yes. Okay, so the final, City or Inter?
No hesitation, City.
Okay, there we go. That was easy. That's why you wanted an easy one at the end. Mohammed, it's good to see you. Good friend of this program, good friend of ours. Mohammed Al-Erin there on the latest. Your equity market a bit softer through most of this morning to basically unchanged, now turning positive as we get closer to the opening bell. Let's get you some movers. Here's Abby.
John, let's take a look at a couple of the stocks that are helping the markets go closer to even, maybe even a little bit higher in the S&P 500, higher on the week coming into today. Tesla is having its best day since the end of March, up 6.2% on the news that GM will start using Tesla's extensive charging network beginning in early 2024. Plus, GM will adopt Tesla's connector. This is Tesla's highest level since early October of last year. GM also higher, up 4%. And then take a look at DocuSign, up nearly 7%, jumping on a 32% adjusted earnings beat. Sales were better by 3%. The revenue forecast was better, but many analysts see it as conservative. Net, we've got some big winners here, so let's see whether or not it can pull the indexes around, John.
Abby, thank you. Coming up on this program, investors looking ahead to the Fed as markets enter new territory.
I think that it gets pretty choppy from here, but the demand-supply balance still looks, constructive. So I would say a grind higher, 4,500 by year-end. Soft landing will easily give you 5,000.
If we get a soft landing, Binky Chowder there of Deutsche Bank. That conversation coming up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
At the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
They haven't dealt with the larger framing issue. And you're not going to get me to front run my FT article again. We'll have to wait till Monday. But there's the larger framing issue that is not being looked at. So how they describe that the skip, which the market expects, is going to be critical. Now, if they don't get favorable inflation numbers, they're in a really hard situation because they will have to surprise the market. So it's going to be next week is going to be absolutely fascinating.
Next week is going to be absolutely fascinating. Mohamed El-Erian of the Federal Reserve looking ahead to next week. CPI on Tuesday, Federal Reserve after that. If they skip, will they go 25 in July? Lots to talk about. Kit Dukes of SocGen saying this morning. Have we become ostriches with a short-term memory of 10 seconds and a tendency to head off in one direction or another at full speed for reasons we can't remember? Darryl Cronk of Wells Fargo, Morgan Stanley's Michael Kushner, join us now for more. Michael, have we got our head in the sand?
We seem to be bouncing around from one extreme to the other. We're optimistic, we're pessimistic, optimistic, pessimistic. I think that relates to the fuzziness of what's going on in the world. We're in this transition. Manufacturing is weakening. Service sectors are strengthening. Labor markets are changing around. Got strength in some sectors, weakness in other sectors. It's very obscure in terms of what the actual fundamental underlying trends are. So I think we do have a tendency to bounce around in terms of what we think is going on.
Got a lot of history to look at. Darryl Cronk, you wrote this. History shows the S&P 500 doesn't bottom until, on average, 6 months after the first Fed rate cut. That rate cut's not coming anytime soon. At the same time, Bank of America published, Darryl, just moments ago. Let me share this one with you. The bear market is over. 90% plus at a time. The S&P 500 rises over the next 12 months after recovering from a bear. So history cuts both ways here, Darryl. Which one's which?
Yeah, it does. I think the conditions, though, are vastly different this time. And to your earlier question, I think the market's having a little bit of a summer fling that ultimately ends in heartbreak in the fall, as those conditions just keep tightening. The leadership, as you know, is too narrow. I mean, now at the end of May, if you took out the 8 stocks, the index was negative. Now you have to take out the 20 top stocks in the index to get negative. So the breadth is widening. That's positive, right? But you still have 6 of the 11 GIC sectors in the S&P that are negative year to date. Large has outperformed small by 500 basis points, so you're not getting any leadership out of small cap at this point. You should be if this is a durable rally in the next bull market. So the signs are just not there, and frankly, the VIX at 13 and change, implied volatility is just way too low heading into whether it's next week or the summer months. Quite frankly, we think investors should be using that low volatility right now to hedge for that potential heartbreak that may come later this fall.
Well, Darryl, the point that you're making, it is time to get defensive in stocks. Does that translate as a wholesale cutting back of your equity allocation, or just getting more defensive sector-wise?
I think it's a little bit of both. We've been underweight equities in portfolios basically since last year, which served us well in 22, hasn't served us well so far in early 23. But I think you want to look where you can find value. So I think, energy down 7%, most energy stocks trading at 9 times multiples with a 3% dividend yield, to me looks more attractive than other cyclical areas, places, where you have the best to worst technology, best energy, worst dispersion of 41% year to date on sector over sector performance. So we think energy is okay. We think healthcare is good. We would fade probably some of the tech, discretionary, and communication services. They're all up 30% plus year to date.
Massive moves year to date on that front. There's an old cliche that capital goes to where it's treated best. And Michael, I'd be asking you this morning, does it get treated best in equities or in bonds at the moment?
It's a good question. I think bonds are very competitive with other asset classes, equities or others. The high yield market, people will go, well, if a recession is coming, why is high yield so reasonably well behaved? And the reason is you get 8 to 9% yields in high yield in an economy which is doing okay. And an 8 to 9% yield, if there's not going to be a meaningfully large recession, how are you really going to beat that in equities or other components of fixed income? So I think that the high yield market is being held up quite strongly by the fact that people like yield, and yield is high now, even if spreads are not so high.
Michael, you've got all these opportunities in fixed income that you've just suggested. You've seen what's been ripping in the equity market. I'd be asking 5 trillion questions. Why have we got $5 trillion sitting in money market funds if opportunities elsewhere are that good?
Well, I think this is the reason to be optimistic, that even if we have a bit of turmoil in the economy, as long as it doesn't get too weak, the supply-demand imbalance about these financial assets that are sitting on the sidelines, which could be deployed in financial assets, whether it's bonds, mortgages, high yield credit, or in general, or equities, is out there. So I think the longer we go without a recession, and now we're 15 months or so from the tightening, the S&P has come almost unchanged over 15 months. The 10-year Treasury is unchanged basically over the last 15 months since June or 12 months since last year, that people get sucked into the market. And I think as opposed to potentially having a lot of volatility over the summer, we could have a surprising melt up, in asset prices this summer.
Oh, some opposing views there, so let's build on that a little bit more. Daryl Cronk, if people are going to sit in cash, and many people have done, they're trapped there, being rewarded to be trapped, you get 5%, I know that, but elsewhere things are ripping. Just how sticky is that money? And what's the catalyst, Daryl, for that money to start being deployed elsewhere?
Yeah, it's a good question, John, and one we spend a lot of time in strategy committee looking at. I would say, what I think could surprise to the upside, to that point, is even next week. So you're going to have the headline CPI drop a full point from 5% to basically 4% if we hit consensus. And the 3-month average on inflation is 2.2% at the headline. The problem is the core is still running at 5.3 and the 3-month average at 4.8 and still rising, way too high for the Fed. Right? So I do think the Fed has to do more work later this year. The reality is the economy is at basically stall speed. We're at 1.5% GDP growth. That is not enough cushion when you've got the fastest tightening cycle since '81, and 7 of the last 9 Fed tightening cycles have ended in recession. So we still think later this year the true data and dynamics play out and the economy does drop into recession. We're already there on earnings. We've had 2 quarters in a row of negative growth. Leading economic indicators are in recessionary territory. The data just doesn't suggest otherwise at this point.
How would you suggest the winners of the moment would perform in the downturn that you're anticipating? What would happen to NVIDIA? What would happen to Meta?
I think they have to come down here. I mean, look, they're up, 70+%. I mean, it wasn't that long ago, John, we were writing about a crypto bubble and a cannabis bubble, right? You could argue that there's some AI bubble-ish tendencies here of what's playing out right now in the latest move. Technology has done well, but as I said before, if you get below the surface and I take out those top tech names, the vast majority of even the S&P 500 technology sector is still off 20% from its previous 52-week highs. So even the tech sector, broadly below those names, is not participating as widely as it should, again, if this is a durable, sustainable, broad-based rally.
Daryl Cronk, Michael Kushner, to the two of you, thank you. Going into the weekend, enjoy the weekend, gents, and let's hope today is a quiet session going into a busy week next week. Coming up, the morning calls, and later we'll catch up with Alpine Saxon Woods' Sarah Hunt, joining us around the open and about and taking a look at Tesla too. That stock doing better than good this year and doing okay this morning too.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Month to date so far, big outperformance in a Russell. So far in the session, bit of underperformance. We're negative there and slightly positive on the S&P 500. That's the price action. Let's get you some morning calls. First up, Piper Sandler raising its price target for Oracle to 130. The analyst citing favorable AI and cloud tailwinds. Next up, Guggenheim cutting its price target for Nike to 135, expecting slower than expected China recovery to weigh on earnings. And finally, Citi, more than doubling its price target for Carvana to 25, playing catch-up, highlighting the company's improved outlook amid a stabilizing auto market. That stock at 25.47 and positive 5%. Coming up next, another win for Tesla's Elon Musk.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Heading towards a fourth week of gains on the S&P 500, potentially the longest weekly winning streak of the year so far. On the Nasdaq, slightly negative on the week, and on the month, only up by a little more than 1%. So as we assess the bull market from the lows of October and talk about this narrow leadership, keep an eye on where the recent outperformance has been in a Russell. The Russell up on the month by a little more than 7%. There's your opening bell. Switch on the board and get to the bond market. A bond market that's been squeezed whipsawed by developments over the last couple of days. The Central Bank of Australia, then Canada, surprising with rate hikes, sending yields higher. Then we had a little bit of soft data in America, jobless claims disappointing, flying higher. The wrong kind of upside surprise on claims, driving yields lower. This morning, yields up again by 3 or 4 basis points, going into a busy week next week. 375.68 on a 10-year, on a 2-year this morning. We look at a little something like this, up 5 basis points to just north of 456. That means the dollar showing a touch of strength, the euro some weakness, 107.69. And look out below on crude, just about holding on to 71 here. We're down by 0.2%. For the broader equity market, about 40 seconds into the session, we drift higher on the S&P by 0.3%, on the Nasdaq up by 0.5. The one sector to watch at the open, EVs. Tesla shares climbing for an 11th consecutive day, thanks to GM's agreement to join the company's charging network. The GM CEO, Mary Barra, writing in a statement that the partnership could, quote, help move the industry towards a single North American charging standard. Ed Ludlow has more. Morning, Ed.
Yeah, currently headed for 11th straight day of gains, as you point out, John, matching the streak that Tesla hit in January of 2021. I don't often do this, John, but I'm going to get technical because I look at this stock. RSI has just hit 86. We're trading above 200, 150-day moving averages. Just the momentum's there, but how long does this last is the question. In terms of the details, from 2024, General Motors EV owners will have access to the Tesla Supercharger network, around 12,000 additional chargers, but they will have to use an adapter. Starting in 2025, GM will modify production so that the EVs they're building have a North American charging standard, or NACS, port, making it easier. Of course, this is a move that Ford has already announced, and reading the sell-side reaction, industry participants and sources that I know, this is now relatively definitive, right? You have the 3 biggest US-based makers of electric vehicles adopting this standard. The assumption now is that the rest will follow, and that those operating charging networks with CCS standard, you look at names like Electrify America, EVgo, and ChargePoint as examples, they now have to think about what they're going to do in order to remain competitive. But Tesla, wow. Tesla now changing how we think about it in some ways, but the stock up 6%, 11th straight day of gains, and trading at its highest level since the first week of October.
And not just Tesla, Ed, but GM, General Motors as well. Ed, can we just sort of sit on this for a moment longer?
Please.
What a win this is for Elon Musk and Tesla. Frozen out of talks at the White House when others were going around cozying up, talking about GM, Ford, Mary Barra, very close seemingly with the President of the United States. And then this is the industry, this is the individual setting the industry standard for everybody else. And how much of a win is this for Elon Musk?
Yeah, look, I started reporting on Tesla in 2018, and it's completely fair to say that since that point, everyone, whether you are a competitor, a Tesla employee, an investor, or an analyst in this field, they accept the technological leadership that Tesla has, both on the sort of product vehicle side, but also the charging infrastructure. Tesla moved quickly and invested heavily in charging. Now that is starting to pay dividends. I also would point out, John, how this came about. Mary Barra broke a 7-month silence on Twitter, tweeted it, and then did a Spaces with Elon Musk. And it makes you think about, the kind of position that Elon Musk and Tesla are in how they're engaging with their industry peers.
Just a big win in a big way, and doing it on his platform, as you suggested. Ed, thank you. Ed Ludlow there on the latest. Dan Ives of Wedbush adding Tesla to the best ideas list as if it wasn't there already for him, raising its price target to 300. I'm saying this, quote, we believe this is a large monetization opportunity. In a nutshell, Musk and Tesla are playing chess, while other automakers are playing checkers in this broader EV green tidal wave. That stock is up by almost 6% and higher by close to 100% year to date. Just a phenomenal run in 2023. I want to stick with the autos. Carvana extended gains following a record one-day advance. Bloomberg's Abigail Doolittle has more. Hey, Abby.
Hey, John. Well, it is really pretty amazing because this stock is up 12% after that 56% record climb yesterday. Over the last several weeks, 9 days are comprised of days that are up more than 10%. So huge, huge gains. But what's so interesting, on the week, the stock up 70%. It's only the best week since early February. That speaks to the volatility, and a lot of the volatility has to do with the shorts. There is a 51% bearish short interest on this stock. And if you take a look at the shares from the peak, they're down about 90%. But from last year's low, they're up 600%. Again, speaking to the volatility yesterday and recently, the shorts really getting killed in this. And of course, has to do with the fact that EBITDA outlook for the current quarter of about 50 million, much better than the projected loss, helping folks, investors, become a little bit more comfortable with the idea that this company, this online car company, is cutting costs and maybe turning a corner.
The surprise being they might actually make some money, some EBITDA, some profit. Abby, thank you. We're up by 11% in early trading there, adding some more weight to the recent rally for Carvana. Turning to retail, what a struggle it's been for Target. Under pressure as Citi cuts the stock to neutral. The analyst saying slowing sales and traffic piling up. Target's high exposure to discretionary sales will not serve them well in the current macro backdrop. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, slowing foot traffic, tough competition. It's a toxic combination for Target, at least if you ask Citigroup. The bank's traffic tracker data showed that foot traffic slowed in the last week of May, and then it slowed even further in the first week of June. That led them to this downgrading Target to neutral from a buy. And making matters worse, of course, Citi here sees Walmart gaining market share. Like you mentioned, Target does have that high discretionary exposure that's not great in this environment that we're living in of slowing growth and still high inflation. Now, of course, this downgrade follows a pretty brutal stretch for Target stock. If you look year to date, it's down about 12%, down 16% just in the past month or so. But Citi says the risk here is for further downside, and you're definitely seeing that this morning. Shares off about 1.8% at the moment.
Casey, have you noticed that the South Side are very willing to talk about the product mix at Target not being favorable to the stock, but less willing to talk about the elephant in the room, which is the tension between them and the LGBTQ community?
You have seen that a little bit. It kind of makes sense here that they're sticking just to the product mix, but those social issues, very, very much, if you look on social media, it's a different story.
Dominant at the moment. That's the dominant part of the conversation. Katie, thank you. That stock is down by about 1.7%. Really weak run over the last few weeks, that's for sure. Also looking at DocuSign, shares jumping after the company beats Q1 earnings. The CEO writing in a statement, quote, "As we continue to execute on our strategy and leverage our competitive advantages, notably in, guess what, AI, DocuSign is well positioned for the future." Isabel Lee has more. Hey, Isabel.
Hey, John, it looks to be a great day or a great start for DocuSign. Shares rose around 10% when the market opened and now has since paired gains to around 4%. Year to date, it's up 10%. So it's a beat across the board. Revenue jumped 12% year over year and increased by the same percentage in the subscription side. Adjusted EPS rose to 72 cents. That's compared to 38 cents year over year and the 55-cent estimate. The company announced a slew of new products and services, and many analysts were bullish. They said that they were impressed, and Wedbush, again, also increasing its price target for the company. Some, however, didn't think that it was that impressive when it comes to their outlook. They thought that it was a bit conservative.
Stock up 2.8%. Isabel, thank you. I think Lisa called that a pandemic darling a little bit earlier on this morning. A few of them doing well. Thinking of Carvana the last couple of days too. Your broader equity market positive by 0.2% this morning. We've heard a lot from the bulls.
I think that it gets pretty choppy from here, but the demand-supply balance still looks, constructive. So I would say a grind higher, 4,500 by year end. Soft landing will easily give you 5,000.
You've also heard a lot from the bears. Bank of America's Michael Hartnett writing, quote, "Q1 recession fear replaced by Q2 Goldilocks greed. The S&P 500 breaking out bull market bubbly," though he stresses that if you have a look at how things progressed through May, you take out a magnificent 7, and we're up more than a sober 1% year to date. The Fed ain't done with hikes, so we stick with sell the last rate hike call. That's his call, stays bearish. Michael Hartnett of Bank of America. With us now for her perspective, Sarah Hunt of Alpine Saxon Woods. Sarah, is this a market you want to chase or one you want to run from?
It's such a difficult question, and I think that this is what everybody is struggling with right now. I think part of the move in the Russell has been a bit of a catch-up, so everyone's buying the laggards because you've seen the S&P move ahead, again, in a very, very narrow way. I think it really is going to depend on how that CPI data comes in next week and what the Fed does. But you're facing a bunch of tailwinds that are coming for companies, which is partially on the earnings front, because if you do get that drop in inflation that people are hoping for, that means the Fed can slow down or even pivot, which we're not even talking about anymore, it means that you're going to see some degradation of earnings because some of that earnings bullishness has come on the back of inflation and not driving revenues higher. You also have some issues coming in with spending, with student loan resumptions. And I think you're just going to start to see some issues on the consumer side. And I think some of the weekend of that you're already starting to see in things like Dollar General.
So, Sarah, have you got your doubts about the outperformance we've seen so far this month on the Russell? It's pretty big outperformance. The small cap's up by something like 7% plus. The Nasdaq, despite the headlines, which cover what's happened since October, the Nasdaq over the last few weeks hasn't really done it.
Well, I think there's somewhat of a catch-up here because the small cap stocks had not had any sort of recovery. So I think to the extent that people are looking at the economy and saying, well, maybe it isn't going to be a terrible recession or a deep recession, or maybe we're just going to get a slowdown, that's positive for the stocks in the Russell 2000 because they're mostly domestic facing and they should see some growth if the economy isn't terrible. I think the bigger question is overall market and some of the multiples that we're moving to, where do those stocks go and what does the Fed do? And how long do we stay at higher elevated interest rates? I think that's going to be a big part of the question of how equity markets can perform over the next 12 to 18 months.
Well, let's talk about where the surprises have come from, Sarah. The labour market is so much stronger than we thought it would be at this point of the year, looking back, say, 12 months ago, looking out 12 months. The housing market is so much stronger in the face of 5% Fed funds and 7% mortgage rates, given that still, as far as I'm told by places like Redfin, a third of purchases in this country are being done all cash. Are we finding out, and I asked this question to Mohammed about 40 minutes ago, are these long and variable lags a whole lot longer, or are we just finding out this US economy is a whole lot more resilient?
I think it's a combination of the two. I think it has to be an and. Part of the issue on the housing front is that you don't have a lot of people in existing homes willing to sell those homes because their mortgages are so low. And to the extent that so many people are buying with cash and developers are able to offer some sort of incentives to get people into brand new home sales, I think that's part of what's driving the home market, but that's still bullish for the home sellers, right? So that's a good thing for them. On the labor side, you did see one increase in jobless claims. 1 week is too short a period of time to even try to extrapolate that data. But I do have to think about when I go through places like the New LaGuardia Airport and everything is a kiosk and there are very few people working in some of those retail stores, if that's going to be the new way that companies goose margins, which is making sure that they have the least amount of employees possible. I am a little bit concerned about that going forward, but I think we just have to see how that plays out.
Sarah, given everything we've just said, favorite sectors right now, what are they?
I know this is going to sound like a broken record, but we still like energy. It's had some issues going forward. They're still releasing oil from the SPR. You would think that with oil prices down this low, they wouldn't be doing that. I think that there are some things that are going to reverse that are positive on the supply side, that even if you don't get a major cut from Saudi or the fact that you've got more Russian crude on the market than we thought we would have, you're going to have a reversal of some of the ability of countries to keep pulling oil out of those strategic reserves that they have as well. And I think that you've seen almost a trough in gas prices. I don't want to call that here. It depends a lot on weather. But the U.S. has definitely got a different dynamic going on than Europe does on the energy front. And that's been favorable to consumers so far this year.
Sarah, why do you think it's so out of favor in 2023? This trade did so well the previous 2 years.
I think partially because it did so well the previous 2 years, partially because people are still looking at that ESG component and saying, you know what, hydrocarbons are going to go away. Well, there's going to be a transition, but that transition tail is going to take a lot longer than a lot of people are expecting. So a lot of the companies that people have given up for debt are not really going to die, especially not in the next 5 to 10 years. And I think that that's an important part of the global conversation that we need to be having, because you look at countries like Germany that are stuck with higher energy prices for longer because of choices that they made in the last several years to get rid of some of their conventional energy supply. And you have to think that that conversation has to be more broadly based, and you have to think about all the different pieces of that puzzle.
Sarah, just to finish then, can you describe the type of energy company you want exposure to? Not all companies, as you know better than me, are created equally. Where do you want to be? Where don't you want to be?
Well, I think that right now we see some positive momentum for the service sector. If you really are troughing on the rig count, you've got some U.S. service stocks that can do well. I think that there are places that play into some of these transitions like LNG. I've mentioned Chart Industries before. I still think that that's got some really good possibilities going forward, because you are going to see a larger grouping of LNG companies do better going forward. Some of the majors are more involved in that than others, and some of the majors are looking at alternative fuel more than others. And I think that trying to pick and choose within those is really where you want to be looking in the energy sector right now.
Sarah, does it matter who's in the White House? I asked that question because think about who's in the White House right now and how well energy has played out through his term.
I think it matters in terms of policy directionals and longer term, right? Energy stocks tend to trade in waves, and you try to catch them when they're down and get rid of them when they're up. Well, we're back down to energy being 2% of the S&P right now versus the 6 or so that it was just recently on the run-up in energy prices. I think the longer term policy directives matter, and I think whether or not you can get permit reform and some of the other stuff that has been talked about, I think that does matter. But it doesn't matter if you're in the middle of a long cycle one way or the other. It's not as important who's in the White House, but it is part of the longer term consequences.
Sarah Hunt, thank you on the latest. Still likes energy this morning, a little bit softer. Sarah, have a good weekend. It's good to see you. 15 minutes into the session, equities positive by 0.4%. The outperformance again on the NASDAQ. Coming up, the politics. Former President Donald Trump indicted.
It's election interference at the highest level. I'm an innocent man. I'm an innocent person.
That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the wizards and capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
It's election interference at the highest level. There's never been anything like what's happened. I'm an innocent man. I'm an innocent person. And we will fight this out just like we've been fighting for 7 years. It would be wonderful if we could devote our full time to making America great again. And that's exactly what we did. But now Again, our country is in decline. We're a failing nation, and this is what they do.
According to 3 people familiar with the matter, the former president indicted over his refusal to return classified documents found at his Florida home. A former president has never been charged with committing federal crimes.
Trump's not the only person that's had took records home with him. There's kind of a broader historical question about how these laws were enforced, and you know, the President Trump is trying to make a case that both there's different treatment here for him, as well as a situation where these laws were never enforced in the way that the Justice Department is proposing to enforce those laws. You know, those are both questions that the Justice Department is going to have to answer as this case moves forward.
We get lucky this morning in New York. Bloomberg's Anne-Marie. AMH, where are we going with this?
Well, he's been indicted, Jonathan. This is according to the reporting that's out there, including in Bloomberg News. And obviously, everyone's talking about what happens on Tuesday, because then he'll have to show up to court. And this is being handled in Miami. What we do know from this indictment, and we could get the document released as early as today, the former president faces 7 charges. They contain willful retention of national defense information, corruptly concealing documents, conspiring to obstruct justice, and making false statements. Jonathan, some of these allegations could mean the former president could face 10, even 20 years in prison. Now, obviously, he is a former president. No one thinks that he potentially could face this kind of time behind bars, but these are serious, serious issues. His own Attorney General, Bill Barr, leading up to this indictment, had said that this is going to be the hardest case for the former president, given there is a lot of legal challenges around him now. And he almost also said it's of his own doing, because he was there, in Bill Barr's words, jerking around the DOJ when all they wanted was these documents back. And the former president, we saw that in the raid in Mar-a-Lago in August, was not giving them back. And there had to be a subpoena, and then they had to go take them.
Could you build on that, the difference between what's happened here in this case and what's happened elsewhere, when we've heard tons of stories of current officials, former officials, who have done something similar, taken documents they shouldn't have gone home with?
That's right. You have the former president's own vice president, Mike Pence, had documents taken home. He called the authorities. They came, took them, and now that case is done now, and that they're moving on from that. The current president as well, Joe Biden, had documents found as well in his home and his office. They called the authorities. Authorities then came and checked all of his properties and took those documents. There's a special counsel right now facing the current president, Joe Biden, that is still pending. The difference is, obviously, Pence and Biden both called the authorities and wanted nothing to do with these documents, knew that they had to go back to the National Archives. The former president, what many believe he was doing, was hoarding these documents. There was a subpoena to go get them, and he would not give them up.
AMH, on the latest, when we get more facts, we'll bring them to you on Bloomberg TV and radio. Anne-Marie, good to see you here in New York, of course. 22 minutes into the session, call it 23. We're advancing by about 0.5%. The NASDAQ is where the outperformance is this morning. Abby has more. Hey, Abby.
Hey, John. Well, it certainly has to do with those big tech sectors really to the upside. And on the week, the S&P 500 higher for a 4th week in a row, the longest weekly winning streak in almost a year, well, since August of last year. But take a look at consumer discretionary tech and communication services, all higher to the downside, materials, energy, and utilities. Let's take a look at a theme that is just really the big theme this week, which is, and the month, to your point, is the Russell 2000 really outperforming, up 2.5% to the NASDAQ 100, up 0.7%. This doesn't quite illustrate the degree of the spread there, but nonetheless, we have outperformance for small cap.
Abby, certainly not the story of the year anyway. The story of the week, the story of the month. Abby, thank you for that. Outperformance on the NASDAQ, the S&P 500, a clean break of 4,300.
is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Bloomberg.
As you were, the outperformance on the Nasdaq returns on the S&P 500, clean break of 4,300 on the S&P, the highest since April 21, 2022, a new high for 2023. That's the price action. Here's the trading diary. UBS could complete its Credit Suisse takeover as early as Monday. US CPI Tuesday, PPI Wednesday, the Fed Chair Jay Powell holding a news conference after the Fed decision on Wednesday. Then on Thursday, an ECB rate decision. On Friday, it's the BOJ's turn, followed by UMich consumer sentiment to round out the week. That rounds out a week for me. Enjoy the weekend. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said
Connection
to them,
lost.
you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go